Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. Brad Smith is off today. Here are three things you need to know this morning. Investors look for traction at the start of a week punctuated by Fed Chair Jay Powell's speech at Jackson Hole. He's expected to strike a more measured tone after last week's minutes hinted at upside risks to inflation. Global yields remain elevated with the 10-year again near its highest level since November 2007. The S&P 500, meanwhile, flirting with its biggest monthly loss of 2023. Nvidia is the earnings report of the week. The GPU giant has become something of a proxy, of course, for the AI trade, with its technology powering applications like ChatGPT and Google's Bard. Last quarter's results, though, will be a tough act to follow. A strong forecast saw shares jump 25%. This time out, we'll be watching for continued strength in data center revenue and whether demand for gaming chips as well is holding up. And Hilary makes landfall in Southern California, hitting as a tropical storm, the state's first since 1997. It has since weakened to a post-tropical cyclone, though that still brings heavy winds as it moves over central Nevada. The focus is on continued rainfall, with flood watches in effect for over 25 million people. If all that wasn't enough, a magnitude 5.1 earthquake hit northwest of Los Angeles as the storm passed through the region. That, though, did not cause major damage. Well, starting the week with the next big catalyst for markets as the S&P 500 is on course for that biggest monthly loss so far this year. We're continuing to keep an eye on Treasury yields as the 10-year and 30-year are on track to reach past highs as wary investors come face to face with sticky inflation and the possibility of more policy tightening. All eyes looking to central bankers gathering in Jackson Hole, Wyoming for their annual meeting later this week. Fed Chair Jerome Powell speaks on Friday. Investors hope to hear a little more balance in his tone. Our Jennifer Schomburger will be out there covering it for us. To talk about that and what investors should be watching, joining us now is David Waddell, an associate CEO and chief investment strategist, and Max Wasserman, Miramar Capital co-founder and senior portfolio manager. Gentlemen, thank you so much for being here. Max, I'm going to start with you because you are sitting next to me here in the studio. It has been sort of a tough ride so far this month. Is the Fed the major obstacle here? And what do you think we're going to hear from Jay Powell on Friday?
Well, it's nice to be here, so thank you. Yes, I think it's the obstacle, but it's perception of the obstacle. Everybody's still concerned that the inflation still needs to be tamed and the Fed still needs to be more aggressive. We're under the opinion they do need to be more aggressive. Right now, you still have inflation running at 4 to 5%. The real rate returns are still basically zero with this inflation rate. So we think the Fed needs to be more aggressive in shutting down inflation, which is probably on the minor viewpoints. So we think that's it. The other thing is the market's had a huge run in the Nasdaq. So you've been up 30% in the Nasdaq, about 18% in the S&P, which is really concentrated in the Nasdaq and your AI plays. So we think this market's perception, where do you go from here? Especially with the fact that you're still seeing growth in the market and the consumer's still not slowing down. Real estate prices are high. Credit card debt is at a number, it's pretty large. So you're looking at concern. And if the Fed gives you any type of indication that they're going to raise more than people anticipate, they may be more than a quarter even, maybe 2 or 3 more times, this market's not strong enough to handle it.
So sort of on a related note then, David, is there more sort of upside or downside risk associated with that event on Friday?
Well, I think it's important to frame it in a way that this moment we're dealing with right now is not an economic problem. It's not a stock market problem. It's a bond market problem. And the reason is because the Treasury issuance is blowing out. We had 5% deficits. Now we have 6% deficits. We're headed to 7% deficits. So they got to sell $2 trillion worth of Treasury bonds over the next 6 months. By the way, we got 2 auctions this week. So to me, this is sort of the downside of the whole government spending binge we've been on. There's just a whole lot more issuance coming to market at a time when the banks are stepping back. Let's not forget, last time rates were at this level, we lost Silicon Valley Bank. That's not lost on Powell, so that may soften his tone a little bit on Friday. The Japanese are stepping back because they've raised their reference rate. The Chinese are stepping back because they got to defend their currency. The retail investor is stepping back because they can get 5.25% on a money market fund. So the issue is the Treasury is dumping a lot of supply on the market at a time. Remember, the Fed's stepping out too. So you've got demand receding, and that is leading to this spike higher in rates. And so the 50 basis point backup we've seen in the 10-year has led to about a 5% correction in the S&P and about a 7% correction in the Nasdaq, which is because multiples get compressed. So the economy is an issue we can talk about, and the stock market's an issue we can talk about, but until rates settle down, until we find equilibrium on the long end of the yield curve, multiples are going to be confused, which means the stock market's going to be confused. And so I think your other guest is right in that we had such a huge run in the high multiple stocks, which created vulnerability. But I don't see this as anything that's structurally changing. I think it's more sentiment, seasonal, and supply related. So I think you use this as an opportunity to add to positions going into, call it, the middle of October.
Max, so let's follow up on the bond yield conundrum right now, right? How high do you think yields can go from here? Sort of almost separated from the Fed, given the dynamics that David's talking about, and how much of an obstacle is that going to continue to be, particularly for high growth stocks, big tech?
Well, it depends on where in the yield curve you're looking at, right? The short-term rates, you could see that go up to 5.75, maybe even 6. And that's presuming that you have inflation, right? That it's not under control. I mean, you have to look at it. The market multiple is 20 times forward earnings at a higher rate than it's ever been in probably about 20 years. So when you put it at that, how much you're willing to spend, the cost of capital has gone up. So if your cost of capital continues to rise, and we see it continually to rise, especially in the 10-year, then it's harder. It's harder to put these multiple valuations on it. Housing, for example, try to get a jumbo mortgage right now. It's like over 7.5%. We're seeing credit cards at $1 trillion at an all-time high. You're seeing delinquencies start to pick up. So while I agree that it's not an economic structural problem yet, but what you are going to see is a slowdown in the economy, and it takes time. It takes 3 to 6 months every time the Fed raises interest rates. And if they're not done, we haven't still seen the effect of all the tightening in the credit. And I think you're going to see that. And I think the higher multiple stocks are going to feel that effect. So I think you could see another 50 to 100 basis points on this yield curve. And if that's the case, this market cannot withstand it.
Well, and sort of on a related note to what you were saying before about the Fed needing to still go to combat inflation and the long and variable lags that you just referred to, that 3 to 6 months, does that mean we could potentially see a skip in September and a raise in November if the Fed says we want to wait for a little more percolation before we move?
I think it would, as a Fed watcher and a big Fed critic for many years, I think he's been behind. He already skipped once. I think he needs to come out and give you another quarter point. And then if he wants to slow it down, if he slows it down now, then the perception of inflation still will be out there. If you get a big print in GDP or core inflation, which core inflation is still running high, then he's going to be behind and people are going to expect even greater. So I think he needs to do a quarter. Try to predict what Fed's going to do at times, it's anyone's guess. But we do know the cost of capital is higher. And when you have to discount these high multiple stocks, it makes them worth less. And I would argue that really if you take the market as a whole, it's not that much up. I mean, if you think about it, if an equal weighted basis is up about 5 to 6% for the year. So the majority of this market is concentrated, which means it's vulnerable, especially with high multiple. And I know you mentioned Nvidia earlier. It's hard when everybody keeps putting so much pressure on these same large cap growth stocks to deliver the market, especially when multiples are rising and interest rates are rising. So we do see the economy having a slowdown, but we see it already starting to take effect. You're starting to see it in spending habits. You're starting to see trade downs. But the market itself, the economy itself, is still very strong, and that's why we think the Fed needs to be a little bit more aggressive.
So, David, given this discussion here, you talked about maybe adding to positions and things where you have conviction right now. But the backdrop, how long could we see and how deep could it be, this pullback that we've been seeing in stocks?
Well, I think that goes back to the point your other guest just made, which is if the economy is softening, if China is exporting disinflation, and outside of housing, there really isn't inflation in the numbers, then why are rates going to go so much higher? I have difficulty with that. Not only that, but remember that while the Fed controls the policy rate, the real interest rate is what matters for the economy, and that's going through the roof as inflation's come down and then the headline rates go up. So I'm not sure the Fed really does have to do a whole lot more. So I think Powell will recognize that the last time we were here, Silicon Valley Bank failed. So if he comes out super hawkish, he could break something. Additionally, you've got real rates going up. You've got the 10-year going up. So the market's doing a lot of tightening for him. I don't think he has to do more. So I actually anticipate that he'll end up being softer at Jackson Hole. But to your point about how much further down do we go, so bullish sentiment, which I look at in the short term, it tells you more than anything, had gotten to about 51, 52% for the retail investor back at the end of July. That was way too high. So we had to have a correction there. We've gotten down to about 35%. Where we want to be is about 20%. So let's say, Nvidia misses the mark on Wednesday, the AI hype balloon sort of loses some air. That could depress sentiment a little bit more. Maybe, Powell does come out and say something hawkish, which I don't think he will. That could depress sentiment a little bit more. That'll set us up for a year-end rally. Let's not forget that on average, September and this period through the middle of October tends to be sort of lame for the market anyway. Volumes are low. Lots of crosswinds. And so we needed a sentiment reset. That's what we're going through. And let's not forget, we went down 9% back February through March when we had the bank failures and ended up by the end of June being up 19%. So I view this as a regular sort of course of activity for the markets. And I think, again, it's sort of anomalous because there's so much treasury supply coming to market and amidst, weakening demand. So maybe those persist for a long period of time, but I don't think so. And he's right, we are in a 5% world. The equal weight's up 5%. By the way, the corporate bond yield is 5%. You can get 5% on a money market, et cetera. So there are a lot of equilibrium points sort of being met in here. We're going to need a catalyst to ignite things. But I think there'll be a Santa Claus rally once we get the sentiment reset, because earnings are going from here at 220 to 270 over the next couple of years, and that's just going to drive markets higher.
Wow, early mention of the Santa Claus rally there, David. Just real quick, you mentioned still the risk that something could break if rates go too high. Just very briefly, what would be the prime contender for breakage at this point?
Well, it's kind of interesting. The banks have really stepped away from duration risk. I mean, they are not buying these treasuries. And so I think we've cleaned out a lot of that. And let's not forget, the government put an implicit guarantee. So right now, what's possibly breaking is more likely offshore, right? A lot of squawk around the shadow banking system in China, a lot of issues there that can ricochet through Europe. So I don't know that we have domestic breakage at this point in time, but you never know. To me, it's more likely that breakage could come overseas with a large default or something like that just surprises market, which ends up depressing sentiment, which sets us up for a buying opportunity and the roll into 12 months from now, markets being higher.
Max, real quick before we leave you, same question for you. Where do you see the biggest risk of breakage?
I think the biggest risk of breakage is a credit slowdown. I think that as the banks are slowing down their lending, as you see the consumers start to slow down, trade down, I think that could be an issue. And 270, 240 is very optimistic with this market multiple. So if you don't deliver on those earnings, your downside is much bigger in that area of the market. I don't think the general market, by the way, in that area of the market. Because look, if you're at 240 now with the expectation, that's 20 times. If you're looking at it with no hiccups, so we're not really negative on the market. We just think there's a lot of opportunity for pullbacks in a very concentrated market. But we think the consumer is going to start feeling it. We think you're going to see the credit slow down. You're going to see it as the banks. I a little bit disagree on a failure of banks. It was mismanagement, in our opinion, on the banks of handling duration. But small banks are pulling back. Everybody will start pulling back, and that slowdown is going to affect earnings to be 270, 240. I think that's a little optimistic.
All right, we shall see.
It'll also take the multiple down, though, or up with it as inflation comes down. So you've got an offset there. And also, mid caps are at 14 times. So you can find cheap stuff in this market.
I agree with that. You can find. But in the technology, when it's a market cap weighted, and the Nasdaq is basically accounting for the majority of the return, I think you have to look outside that area for finding real return.
Well, and
on that we
be
agree.
A big decision maker. All right, a little agreement, little disagreement. What's a good conversation without that? David Woodell and Max Wasserman, thanks to you both. Really appreciate it.
Thank you.
Thank you.
We've been talking around Nvidia, and I want to focus more squarely on that now because it is leading their earnings story this week. The company is set to report its second quarter earnings after the bell on Wednesday, and of course the bar is being set high, very high, you could say, after Nvidia smashed analyst expectations last quarter, in particular with its forecast. While its guidance and CEO Jensen Huang's commentary could lead tech stocks higher, the sector, of course, has seen some pullback in August, with the Nasdaq down more than 7% in the last month. Let's bring in Paul Meeks, portfolio manager at Independent Solutions Wealth Management, to weigh in. Of course, a tech investing veteran who we speak to regularly. Paul, it's good to see you. It feels like a lot is riding on Nvidia after it set the bar so high last time. How are you thinking about it, not just for itself, but how it's going to set the tone for broader tech?
Well, it's absolutely critical. And you're absolutely right when you call it a very high bar. That's an apt description. Wednesday night, we all know it is no surprise that they will have not just a meat quarter, but a big beat quarter. Last time they reported after the webcast, analysts dutifully raised their numbers by 50%. I've been around a long time. You don't see that kind of smashing of numbers very often, if ever at all. Now, will they repeat that this quarter? I doubt it, but they're going to have to give us a steady diet of good news, right? They're going to have to continue to upside the numbers significantly. And I'm not worried at all about the fundamentals. I am worried a little bit about the valuation and the very high expectations. So when we get into Wednesday night, it will not be about what they do. We all know it's going to be wonderful. It's going to be how investors act to it. Is it going to be good enough? And I'm actually a little bit anxious going into that.
Well, you talk to investors. What's the sort of feeling out there about Nvidia? I mean, it seems like we all sort of agree that the expectations are too high. If everybody agrees the expectations are too high, I don't know whose expectations they are. But when you talk to investors, what are they saying?
Everybody believes that you have to be part of the AI revolution. And I agree. I think there's a little bit of short-term hype versus long-term reality, just like there was with the dot-com stocks in 1999. But if you are going to be a tech investor, as I am, if you are going to be long, if you are going to buy AI, you have to have at least as a major building block now Nvidia. Now, it'll be very interesting to see as we get into the second half of this year what advanced micro devices can offer to compete with Nvidia's GPUs. But as of now, you have to own it if you're playing that theme. So what you do is, it's a core position. When it gets out of control on the high end, maybe you trim it back a little bit. And if it dips Wednesday night into Thursday's open, maybe you buy some. But if you're going to play tech, you got to play AI long term. And yes, you have to have it. You keep it a core position and you just trade around it.
The question is, Paul, what else do you have? You mentioned AMD. We talked to a company called Synopsys last week that is getting about 10% of its revenue from AI at this point. Applied Materials touted its AI exposure. I mean, everybody's talking about AI exposure. No one seems to be getting as much revenue from it at this point as Nvidia is. But where else do investors need to be looking to take advantage of it?
So what you need to do, as I said, you need to be in the GPU players. That's Nvidia now, and that's AMD shortly. Then I think as we ramp AI, you move to the hyperscalers, right? So you have to have Alphabet and Amazon and Microsoft. No surprise there. And then after a bit of a lag, then we'll get into the software applications. But as of now, you start with the GPUs. Next up are the hyperscalers. And there's a couple of stocks that actually have AI polls that their shares were smacked in the most recent quarter. And I think they're probably too cheap. And I think Supermicro, SMCI, with about 52% of its revenues last quarter, acting very poorly after its report, stock way down, I think is a pretty interesting under the radar AI pick.
All right, Supermicro, we'll keep that one in mind. From micro to macro, I am curious about the other large cap tech plays. We were just talking in our last conversation about, the pullback that we've seen in tech, in big tech, about also the relatively high valuations on many of those. One example of these is Apple, which is now in a correction, right? It's down more than 10% from its highs. Is that something that people should be looking at? Should people be sort of nibbling at big tech at this point after that pullback?
I think you should be nibbling at big tech, particularly if you start the month of August and tech is underweight your portfolio. A good benchmark is your portfolio less than a third in tech or not? I would say that would be underweight. But I would say that Apple, unfortunately, is in its fourth quarter of year-to-year revenue decline. And I wouldn't necessarily define that as an AI play among the FANGs or the tech titans or the mega cap tech stocks. I probably would go with all of the above and probably emphasize Amazon over the others.
Oh, that's interesting, Paul. Why is that?
Well, Amazon has had a little bit of a rebirth in their e-commerce business. And when I say rebirth, I'm talking about margin expansion because they have significantly cut costs. And AWS, so their cloud build business, had been slumping, not shrinking, but growing at a slower rate. It looks like that revenue growth rate has troughed, and so we'll have reacceleration there. And I do think they got some AI mojo. Some of it announced, some of it yet to be announced. And so out of all those large cap stocks, Amazon's my favorite.
All right, interesting stuff. I want to ask also, though, about the effect of high rates on these large cap tech plays. This is something we've talked about in the past. That kind of receded. Now rates are back up again, and it does seem to be a headwind for large cap tech. How much of a headwind, how much of a problem is that going to be, and for how long?
I'm a little bit worried about that, or maybe more than a little bit worried about that, because the tech correction, when we had it last fall, really was driven not by any kind of change in fundamentals, but by higher rates. And then we got the belief as we got into 2023, which led to a big tech rally, that not only were rates not going to go up anymore, they're going to go down. They're going to pivot lower. So now that thesis is probably off the table. I don't know if they raise rates again in September or not. But unfortunately for tech investors who really crave lower rates, I don't think we're going to turn around and see that pivot to lower rates very early, maybe not even till late this time next year. So yes, I have some worry about that. That is a clear negative for these tech and aggressive growth stocks, partially offset by this new mega driver called AI, but we'll see how it plays out. But I am obviously anxious about rates if we don't pivot next year and we stay higher for longer with both inflation and interest rates.
We will obviously continue to watch that and check in with you. There is one more specific stock that I want to get your take on this morning, and that is Palo Alto Networks. Palo Alto shares surging about 12% this morning, and that's after that better than expected earnings report after the bell Friday, or at least the forecast calmed investors. Shares of the company actually initially fell when Palo Alto announced the unusual timing of the report, that is after the close on a Friday. Wall Street braced for the worst. The bad news never came, or at least it wasn't as bad as it was estimated. The company announced a bullish guidance for the longer term. Paul, what do you make of the Palo Alto situation? I mean, the company sort of said, we didn't maybe make the best decision with the timing of the release, but I guess that set them up to beat expectations on the flip side.
Yeah, the weirdest thing of all time to have not only a quarterly conference call, but then an analyst meeting that went on for several hours on a Friday night. Usually that is a harbinger of really bad news, right? You get the bad news out of the way on Friday so you can kind of dull the pain before Monday. And so the quarter was definitely mixed, but they also gave 3-year guidance that was pretty bullish. And I'm particularly impressed that they're going to continue to grow their revenues, or should. They're guiding to 17 to 19% per year over the next 3 years. Their RPO, which is revenue performance obligation, probably a more comprehensive measure of future revenues, probably compounds at 25. And the real upside surprise, I thought, was the operating margin and the free cash flow margin. Free cash flow margin pretty close to 40%. And it will come down a little bit, but it's not going to come down much. So, hey, the stock went from 260 to 206. It's going to open today at 236. That's probably still too expensive because you don't want to buy a stock up 12% on the session. But if you're going to own one play long-term in cybersecurity, this is probably the one.
Well, I wanted to ask you about that also, Paul. What does this report tell us about cybersecurity spending in what has been a more austere environment when it comes to tech spending? Or is it just that sort of Palo Alto stands out from the pack, so we can't necessarily draw bigger conclusions?
A key takeaway is that cybersecurity will still be designated spend. It still will be high priority spend, but here's the rub. And even Palo Alto Networks talked about this Friday night. Because the cost of capital, the cost of borrow for its customers is high and getting higher, they are buying the product, they're buying the services, but they're opting for deferred payment plans. And so we have to keep an eye on this, because even though you want to spend on something, if you can't, you could be in trouble. So that is why the company is pushing for this RPO metric instead of following the revenue metric, because the RPO captures not only invoice sales, but soon to be invoice sales. But yes, the higher cost of capital is starting to impact not necessarily the budget, but the pace of spending that budget, even though cybersecurity products and services will still be highlighted.
Yeah, that's a really important call out and harkens back to the conversation we were just having with Max Wasserman, where he said that cost of capital is something to watch as it percolates through to a lot of different areas, including consumer spending.
That's right.
One other thing I wanted to ask you about to do with Palo Alto is Nikesh Arora, the CEO, talking about the need to really shorten time horizons, not of the payments, but of their work, of getting on top of cybersecurity breaches more quickly. Is that something that is going to necessitate more spending on the part of Palo Alto and its peers?
Well, I think what happens with Palo Alto, not only did they spend heavily in R&D, but it's an acquisitive company. So if they see emerging cybersecurity threats and better opportunities through M&A to come up with solutions, I think they'll continue to do that. They have a very strong balance sheet, a lot of flexibility. But oh yeah, we are in a very scary market, and the bad guys are always faster than the good guys. So yes, expect everybody to continue to scramble. But it seems to me with their product and software portfolio that among the players in cybersecurity, not everybody is a all-in-one solution, but this is about as close as it gets. And so if I'm going to invest in this space within technology, I'd probably stick with this one.
Paul, it's always great to get your perspective. You're so knowledgeable about all these tech companies. Paul Meeks, Portfolio Manager at Independent Solutions Wealth Management. Thank you.
Thank you.
Well, the storm Hilary rammed into California over the weekend as a tropical storm, battering the region with heavy rains. Rainfall records were broken across the state. Palm Springs saw more than half of its annual average rainfall in just 6 hours, according to the National Weather Service. As if a rare tropical storm was not enough, a 5.1 magnitude earthquake also shook the state on Sunday afternoon. Officials say it's not yet clear if the quake caused serious damage. Though the storm has since weakened to a post-tropical cyclone, portions of the southwest U.S. still face life-threatening flooding. We're going to speak with an insurance expert in our next hour to break down the potential damage from Hilary and what it could cost Californians. Plus, Callaway Climate Insight founder and editor-in-chief David Callaway joins me with the economic impacts of increasingly extreme weather events. In the meantime, in just a few, we're going to have the opening bell and all your markets action. You're watching Yahoo Finance. Welcome back. We just had the opening bell on Wall Street, so let's do a quick check of the markets here to get our Monday morning started. All three major averages in the green. The Dow just barely up almost 12 points. The S&P 500 gaining about 0.25%, and the Nasdaq up about 0.4%. A little bit of a waiting game being played today. Investors waiting for comments from Fed Chair Jay Powell in Jackson Hole, Wyoming on Friday, and from those Nvidia numbers after the close on Wednesday. So let's take a look at the Wi-Fi Interactive to dig into this a little bit. We've been talking all morning about how it has been a negative month for the major averages. So here's the month-to-date figures for the Dow. We're down about 2.2% for the Dow Jones Industrial Average. The S&P 500 on the month down about 2.9%. This is setting up to be the worst month of the year, which is not really a shock, especially not if you've been watching Yahoo Finance. We've been talking about that this is a seasonally weak period for the major averages. The Nasdaq has done the worst of the three by a pretty wide margin. It's down about 4.5%, in part as we have had rising rates, which have tended to be a bit of a headwind for some of these large cap tech and growthy sort of names. If you look at the sectors that are on the move here this morning, real estate's actually down the most, followed by consumer staples. You've got energy and consumer discretionary that are sort of counterbalancing that to some extent. And we've been talking about those large cap tech companies. So let's take a look at how they're trading. Nvidia, I have to chuckle. Nvidia shares are up about 2% today, ahead of those numbers. We were just talking with Paul Meeks about how incredibly high expectations are for this company. The shares are up 200% year to date, a cool 200%, and that's even down a little bit from the highs that they were at. They've pulled back very slightly, but now they're ticking up again in advance of that report after the close Wednesday. We've had a raft of analyst calls raising their estimates and price targets on the stock ahead of the company's numbers. Otherwise, in large cap tech, the other standout is Tesla. That's up 79% year to date. No big deal. Compared with Nvidia, I guess it's up about 2.5% in today's session. So interesting to see that action in large cap tech here today. Jared Blickery is with me now, and we're going to look at some of the movers, the individual movers that are working in the session today.
Yes, I'm taking a look at Nikola here. Shares are plunging today. That's after the EV maker said its 2023 deliveries are going to be at risk after an investigation into battery packs led to a recall of over 200 trucks. Now, Nikola also announced a $323 million convertible bond deal. And Julie, this is a small-ish company. When we talk about deliveries, let me just give the year-to-date totals. In wholesale, it's 76. That's 76 units. In retail, it's 99. So do these recalls really mean anything in the bigger picture? This is a company that's still ramping up. So we'll have to see there. But I was struck by the fact that they're basically diluting their shareholders, $323 million. And also, this is sold by the company directly. They're not using their Wall Street agents to do this. These are people who would be known to the company insiders to do this. And this just really kind of speaks to me as to the company's culture, that it has foregone a number of routes that similar companies have chosen. They had that partnership with General Motors that fell apart years ago. It just seems to be one of these secretive companies. And this raising money directly, it's not necessarily a bad thing, but it just reminds me of something that a small cap company would go and do.
Well, effectively, I mean, it is a small, I don't know what the market cap of Nikola
I think
is
it's
at this point, but
$1.5 billion. So,
okay, so not that small, but
given its production, it is very tiny.
Yes, exactly. And I mean, I guess on the one hand, it's encouraging that they can still raise capital, but they keep needing to do so because they're not making money. They're not making very many cars.
Right.
And, so it's an issue. I mean, the shares are pulling back another 11% today. Nikola has just been, mostly pulling back over the course of its existence. I'm just looking back at at when the company came public. It's now back to 2018, and at the time, $10 a share. Was this?
Yeah, I think it was a SPAC.
A D-SPAC, I guess it was. So from 10.
One of the early ones.
To $1.74.
Yeah, I'm looking at the Wi-Fi Interactive. I'll chart it real quickly before we move on to another EV maker. But this is a max chart, and this spike right here, this was not in 2021 with GameStop. No, this was in 2020. That was on the EV partnership with General Motors I was talking about. That fell apart, but you can see it's been a very steep slog down. The stock was down over 90% at its nadir, and that was only earlier this year. Here's down over 3 years, 95%. And we'll just check out the year to date, which actually does look somewhat impressive now. I'm not responding, but anyway, it does have a nice year to date. Well, 19% down. I'm not going to call that 19. I'm not going to call that nice. I guess you'd have to measure from June now.
I guess you would. I mean, it's funny that even though we're talking about how small it is, the company still ends up on our trending tickers page. So obviously people are still searching for it, whether they're trading in and out of it.
It's well traded. It's a stock. It's a day trader's, a favorite, I would say.
Day trader's delight.
Yeah, day trader's delight.
Let's talk about that other EV maker that you alluded to, and that is XPeng, the company getting a boost this morning after Bank of America upgraded the Chinese EV maker from neutral to buy, saying that cost controls should allow it to turn profitable by 2025. XPeng recently announced disappointing numbers and the shares fell, so a bit of a rebound from that level as well. The analyst there, Ming-Shun Lee, is looking at improved gross margins in 2024 and
from negative levels.
Yeah, so I guess there's no place but up from there. But the estimates are for vehicle gross profit margin to be 0.8% this year, then jumping to 10.2% next year and 14.5% in 2025.
Yeah, you can go through the numbers. They have suffered significantly there in China, as many companies have. Even the year-over-year numbers were quite a bit disappointing in a few areas. But I think the investment by Volkswagen, and this is touted by a lot of the analyst community here, that there were some going concerns with this company, which means there were doubts of whether they could proceed in business, whether they could stay afloat here. And now this partnership with Volkswagen, their investment is $700 million, kind of seals the deal that, okay, this is a legitimate enterprise and they're going to keep manufacturing vehicles going forward. Who knows about necessary capital raises, but this is a company that is actually delivering what? They're going to look to deliver 39 to 41,000 vehicles.
Yeah, I was going to say their deliveries
these are actual
real
numbers.
Yes.
These are real numbers. So.
Yes, and they're also looking at selling outside of China, something else that XPeng's been working on. By the way, the Bank of America note wasn't the only note on the company today, I should mention as well. Nomura is rated neutral on the stock, but did raise the price target to $14 from $8. Jefferies has a buy on it and says the company's on track for a meaningful turnaround. So basically, the analysts coming out here in the wake of the earnings and trying to figure out what the next move is. And it seems like the tenor is a little bit more positive as they take a day or two and take a beat to figure out what's going to happen with XPeng.
Yeah, and I just want to point out these EV shares. Can we go to the Wi-Fi Interactive one more time? These EV shares have been highly volatile, and in fact, we saw this massive short squeeze into the middle of July. A lot of U.S. stocks came into this, and we've seen a back off from a lot of these highs, and XPeng is just one of the others. One of the things that strikes me is though the street, and I'm going to talk about this in the upcoming segment, the street is really up their shorts on this downtrend in stocks overall, so that just means the pain trade probably going to be up going forward. All right, we got to move on to shares of Napco Security. They are plummeting today after the company announced it will restate its financial results for the last 3 quarters after finding errors in the cost of goods that it sold along with inventory. This is a company, I do have some street reactions here. It did catch the street by surprise, but this is a company that has actually produced very stable results, especially looking at a stock chart over the last few years. That is not what I would call stable, but anytime a company has to restate its financials, that is a huge flag, especially with a company that has been so steady-netty for a while here. Here's William Blair, street commentary. It will take several quarters for the company to regain investor confidence. B. Riley, they're lowering their estimate for fiscal year 23 and 24, citing, I quote, possible alarm and service sales slowdown. And then Needham saying likely to be in the penalty box for some time.
Yeah, this is not, I have to admit, this is not a company that was on my radar, but when a stock that is $1 billion company falls by this much, it sort of gets on your radar pretty quickly here. It makes electronic security devices. So that's why they're talking about inventory. Like, usually I don't think of a security company necessarily. We were just talking about Palo Alto a little bit more as having actual stuff, but this is, it actually makes hardware. So that's why you're talking about inventory and a restatement related to that. One interesting comment from Needham that even though the company is likely to be in the penalty box, as you mentioned, the analyst notes this is an inventory destocking issue rather than a structural change in the business. So most of the analysts seem at least somewhat optimistic that after a few quarters it can get back on track, but that is not being reflected in the stock today.
Yes, and we can see on the Wi-Fi Interactive, this one red candle at the very right hard edge of your chart there, that has wiped out the entire year's gains and then some. Let me just put a 3-year chart so we can go back in time, and there you go. Still up 80% over 3 years, but here is that steady climb I was talking about. While so many other stocks were experiencing tremendous amount of volatility, just really really surprising to see something of this magnitude happen to a stock like this.
Yeah.
That's it.
Yeah,
That's it.
We'll see what happens next with it, if indeed it takes a few quarters to get back on track. Jared, you're
Yes.
going to be back in just a few moments.
I will.
To talk about some other stuff at the Interactive. In the meantime, we're going to take a short break. We got much more coming up, including more Jared.
What story is not being talked about enough this year?
I think the story that's not being talked enough is this concept of the recession that everyone's expecting may actually feel and look a lot different. And so we're of the belief that we're actually seeing rolling recessions. And so what's important to investors is really about, are we in a profits or earnings recession? Yes, we do believe that there's going to be an economic recession, but when we look at profits recessions, last year, we saw a profits recession in 7 out of the 11 sectors in Q4 of last year. You could argue technology was in a profits recession last year as well. And so instead of this feeling like everything all at once, it really is going to be this rolling where parts of the economy, like manufacturing, are seeing declines, but other parts seem resilient.
Stocks slid last week as the U.S. dollar and long-term rates surged, making the tech sector the unlikely winner. Meanwhile, areas like meme stocks and crypto saw some of the weakest performance. Jared is back to give us a look at how this week is unfolding thus far, very early on.
Got a mixed board, Julie. Tech, which was the unlikely leader last week, it was the least bad off. All 11 sectors in the S&P 500 in the red, but tech was the least bad off. And then you see Nasdaq is up 0.75%, while the Dow is in slightly negative territory. And let's check out the action in the sectors today, and we see tech, XLK, number one, again, followed by consumer discretionary that has Amazon and some other stocks. Those are the only two outperforming sectors. Utilities and real estate are the laggards here, as is staples. So these defensive stocks lagging is actually somewhat bullish. And let me show you what's going on in the rate space. This is really interesting. Higher rates, 10-year T-note is about to be at multi-year highs here, 4.32%. When we see this going north, we think, okay, tech and growth going to take a backseat, but no, they are number one today. So a little bit of a head scratcher right there. And then just taking a look at the dollar as well, the US dollar index coming off of 5 weeks of strengthening moves here. But I will say, could be caught in the upper end of a down channel. We'll have to see if it turns at this spot. Just having watched the dollar technicals for years, this is something that could happen. So that's on my radar. If it does roll over, guess what? That's going to provide a tailwind to stocks instead of a headwind. That means a wind at their sails. Also want to show the S&P 500. This is over the last 3 years. We are now 5% from the top here. That is quite a healthy correction, if you want to call it that. But we are right at the levels of the August high. So this is a technical level where we may see stocks turn around. I don't think we've hit it quite yet, but that is a huge level that's on my radar. Nasdaq Composite looking somewhat similar. We have this high from over here. And guess what? The Goldman Sachs Prime book is saying that there are a lot of shorts that have re-upped since we have taken this downswing. I'm not sure how much that is in the Nasdaq, but in the S&P 500, that is 5%. That means if we were to turn up again after this short of a decline, the pain trade would be up once again. So we'll have to see how that works out. But in general, we know that August, September, October, these months tend to trade sideways in the presidential cycle. This is the third year of the presidential cycle. In years where we had this huge run up through June and July like we have, we also tend to see a breather in stocks. So maybe we'll just see pain and frustration on both sides, to the upside and the downside, over the next few months, Julie.
Maybe we will. And then David Waddell of Waddell & Associates, we talked to at the top of the show, said after that sort of not so great performance, maybe we'll see Santa Claus rally. I think that might be the earliest mention of Santa Claus rally in a while.
I can smell the pumpkin spice lattes from here.
Oh, no, don't,
Is it too
don't
soon?
do that to me.
Thank
For
you.
me, it is. For
Yeah, me
others
too.
on the team, not so much.
Yes.
Thanks so much, Jared. Appreciate it. Well, stocks in China taking a hit today. Hong Kong's Hang Seng Index falling almost 2%. It's now officially in a bear market. This after China's central bank cut its one-year loan prime rate. This key indicator for most of China's household and corporate loans was trimmed by 1/10 of a percentage point in hopes of the country countering its growth slowdown. That was, though, a smaller decline than some were anticipating. China's central bank also shocked investors by leaving its 5-year loan rate, which is mainly used to price mortgages, unchanged. With China's property meltdown elevating its financial stresses, how much more can the country endure? Yahoo Finance's Rick Newman is here to weigh in. Rick, you've been looking at the tea leaves when it comes to China here. And a lot of investors in the U.S. have been focused on this issue. It doesn't look like that the China is getting out the bazooka here when it comes to stimulus.
No, and some analysts say that it needs to get out the bazooka. So China's economy is kind of a mess right now. And I go back a couple of years, Julie, when there were many forecasts that China's economy would eventually eclipse the size of the U.S. economy, perhaps by 2035, 2030, perhaps even sooner. That does not seem like it's going to happen. That may never happen. There are real problems in China. So we talked last week about problems in the property sector, well known, but there's basically an ongoing property bust there that is now apparently bleeding into the financial sector in China. Some are calling it a possible Lehman Brothers moment in China. So the question here is, should we worry about this? And there's a new note out from Capital Economics this morning saying the effect of China's economy on the global economy and on global financial markets is typically somewhat overstated. So this is reassuring. If you're a U.S. investor, it says the main concerns about that U.S. investors should have are American companies that have a lot of business in China, that do business there. And they singled out Apple and Tesla as two big U.S. names that do get a fair amount of their revenue from China. So some possible risks there. But it is not likely that this is going to bleed over into the global economy or the U.S. economy and cause some kind of contagion. Jared would remember this. Maybe you remember this, Julie. In 2015, there were problems in the Chinese economy that did affect U.S. markets for 6 or 9 months. and we had a real sell-off here because of worries in China. But that turned out to be a little bit misplaced, and I guess Capital Economics is saying that may be the case this time as well. Don't worry so much about problems in China if you are an American investor.
I was in high school in 2015, Rick. No, I'm just kidding. One other thing that has been talked about with regard to China is exporting deflation, right? The idea that there has been deflation in prices there, and because they are such a big exporter of goods to the U.S. and elsewhere, that might actually help the inflation situation. Given, the research that you've been looking at, how credible is that idea?
Well, China has been exporting deflation for decades. The question is, I think the question really is, can they still do that? So you'll see a lot of headlines about the U.S. decoupling from China, and what's actually happening there is the U.S. trade deficit with China, which drove former President Donald Trump bananas. He said it was way too high. That's the whole reason he put his tariffs on a bunch of hundreds of billions of dollars worth of Chinese imports. That trade deficit is actually getting smaller. We are doing less trade with China, but it's not falling off a cliff. So most of the stuff you're going to buy on Amazon, toasters, smartwatches, stuff like that, that stuff is still going to be made in China. So China, to the extent it can export deflation, will still do it. That was interrupted during the pandemic because of all the things we know about. Shipping costs went up. It got harder to get stuff. So China was not exporting deflation, and I think they are getting back to that. It's just probably not going to be as pronounced as it was for 20 years, say, let's say leading up to 2020.
Yeah, it feels like there have been some structural shifts globally. Rick Newman, thank you so much. Appreciate it.
See you, Julie.
See ya. All right, we got much more markets action coming up. Stay tuned. You're watching Yahoo Finance. We talked to Max Kettner over at HSBC yesterday, and he talked about maybe inflation coming back. And he's not the only one who said that. We've talked to some other investors who have talked about it's not going to go in a straight line, in a straight decelerating line. Do you agree?
We do agree, and I do think investors are expecting this already. So we've had a very quick fall from 9% to 3% over the last 12 months. Over the next 6 months, we expect to stabilize around 3% for headline inflation. That's what actually is in investor expectations. But then in 2024, we do expect to continue decelerating and getting to 2% by the middle of next year. So it's been a quick fall, a stabilization, and then a return to normal. And I think that's very much in line with expectations. If we get something different than that and inflation actually re-accelerates, that would be a big challenge both to stocks and bonds.
California gasoline prices are surging past $5 a gallon with no relief in sight. The average price per gallon now sits at $5.26. That's nearly 40 cents higher than a month ago. Yahoo Finance's Inez Ferre is here with the breakdown. So what's going on, Inez?
Yeah, Julie, and we know that Californians had for a while now been paying more for gas prices compared to the national average. There's very high taxes and fees in California on gasoline, and also consumption of gasoline and diesel in California is pretty high as well. Just to give you an idea, 1 out of every 10 gallons of gasoline sold in the U.S. is consumed in California. About 1 out of every 15 gallons of diesel sold in the U.S. is consumed also in California. The concern, of course, is that with the tropical storm, once Hurricane Hilary, that shows up in Southern California, that could have a potential impact on local refining and distribution systems. Now, analysts don't expect that refineries in California would shut down because of the storm that passed throughout the weekend, but it could be that there could be impacts by power outages and flooding conditions as well. So if a refinery were to shut down in Southern California because of, let's say, flooding, you'd see wholesale prices, according to Andy Lippo of Lippo Oil Associates, going up by about 20 cents per gallon. And the consumer would feel it in anywhere between 5 to 7 days. On a national level, where gasoline prices go from here, well, that will a lot depend on the weather conditions. Of course, we are in the middle of hurricane season, and any activity that happens in the Gulf and any refining capacity, any refineries that are interrupted because of that hurricane activity can spike prices by anywhere between 10 and 20 cents a gallon, according to Lippo's estimates. By the way, Julie, right now we're seeing, as you noted, the current national average for gasoline is at $3.87. It's only 3 cents away from what we saw around this time last year.
Oh, interesting. All right. Well, that's right. $3.90 versus $3.87 is not that big of a difference, but people have certain perceptions when it comes to gas prices, for sure. Inez Ferre, thanks a lot. Appreciate it. Well, we're coming up on 10 o'clock here. We've got much more coming up. You're watching Yahoo Finance. is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Julie Hyman. Brad Smith is off today, and we're about 30 minutes into the trading day. So let's take a look at how stocks are moving at this moment. We've got stocks sort of looking for traction here. The S&P 500 up about 0.5% after a 3-week slump. Investors are anticipating big results this week from Nvidia, as well as some insight from the Fed in Jackson Hole, Wyoming, where it's holding its annual conference. Let's take a look at some individual movers as well. Shares of Tupperware are jumping today some 23.5% after an SEC filing shows that Federated Hermes bought about 200,000 shares of the company's stock in the most recent quarter, bringing its holdings up to over 360,000 shares. That's about 0.8% of the company. The firm's stake in Tupperware is now worth about $915,000. Tupperware has been sort of memified as of late. It's frequently on our trending ticker list and has been quite actively traded. Also, shares of Kenvue, that's Johnson & Johnson's newly spun off consumer health unit. They're on the move today on news that the parent company's offer to its shareholders to exchange their shares of J&J common stock for shares of Kenvue was oversubscribed, meaning there was a lot of demand for it. 23.8% of the shares will be exchanged with those J&J shares. J&J is going to retain about a 9.5% stake in the newly separated business. And we're also watching shares of Earthstone Energy. That stock is popping after announcing that Permian Resources is buying it in an all-stock deal valued at about $4.5 billion, including debt. The transaction expected to close by the end of the year with the goal of strengthening Permian Resources as a leading Delaware Basin independent producer. It produces about 300,000 barrels of oil per day. Permian Resources stock, in contrast, was down on this news. Well, generative AI, of course, getting a lot of hype, a lot of attention for the impact it's expected to make in tech, with companies like Google, Microsoft, and Nvidia being propped up as leaders in the revolution. But what about other industries as well? Our next guest is carving a path for this new technology in one of the leading global investment banks. Joining us now, Marco Argenti, who is Goldman Sachs Chief Information Officer, who's in charge of all of the tech efforts within the banks. Marco, thanks for coming in.
Thank you for having me.
So talk to me. I know generative AI is still in the very nascent stages here, but how are you thinking about it at Goldman Sachs and what you're doing with it?
So generative AI, I have to say, I've been in technology now for maybe over 30 years, and it's probably one of the biggest revolutions or changes that I've ever seen. And I guess you might decide whether to buy into the hype or not, but definitely we see that it could lead to profound changes. And we are a fully digital business. We're all about people and we're all about data. We don't have physical operations, etc. And I think those will be the segments and the industries that are going to be disrupted first by AI, because first and foremost, AI is a disruption of knowledge. It's a disruption on the way we actually do business that is knowledge-based, and it really bases itself on the quality of data and the ability to kind of interpret the data in ways that let's say humans are kind of not capable of doing. So we believe that AI could be a profound disruptor, not only of our industry, but all digital and all information and knowledge industries in general.
So what's the biggest opportunity when it comes to generative AI for Goldman Sachs specifically?
The first consideration is that you have to think of AI as both a sustaining and a disruptive technology. Sustaining in the sense that it might lead to productivity gains higher than probably what we've ever seen. But I think I always warn people and CEOs and boards that I talk to that only focusing on the sustaining on the productivity side is not enough if this is indeed a disruptive technology. And so finding that right balance, I think, is absolutely crucial. So on the productivity side, one of the very first targets, and this is kind of where we started, is how to make the technologists and the developers more productive. Why that it could be a good start? Well, because AIs proved to be particularly effective in generating, commenting, and helping you get a better quality code. Because the vocabulary of computers is actually more limited than the vocabulary of humans. And so if you think about it, in that kind of a restricted environment, AIs really perform at their best. But then you kind of walk your way through other non-developer, non-technical workers. And so the next being the knowledge workers that can be disruptive, people that are working in producing content, producing pitch books, or even summarizing large forms or large quantities of data, like earning reports or public filings. We're working on making that much more automatic, much more effective, and really trying to, at the end, in a way, make people kind of having a sort of a co-pilot with them. It's kind of a little bit of an abused term or overused term, if you will, but someone that could actually bring the right information to you at the right time.
I mean, it's interesting what you said about vocabulary. I mean, that makes me think of it as almost a translator between a human and a computer, that the generative AI sort of sits between and helps bridge that gap in a way.
Absolutely.
So where are you inside Goldman Sachs in this process, right, of incorporating some of these new technologies? And what is your process? I know you have a big engineering staff.
Yeah. We definitely have a pretty sizable engineering staff, and we're really looking forward to technologists really to be in the driver's seat to kind of lead this revolution of AI. In terms of where we are, right now we're conducting a number of what we call proof of concepts, and in some cases those are actually starting to be expanded and extended to quite a bit of people within the firm. The first one being the developer productivity, as I mentioned, but we're also working, for example, on the summarization of large quantities of data into the hands of the people that consume that data every day. So we've enabled, let's say, natural language queries interfaces where people can ask really complex questions, such as, given the earnings of this company, give me all the companies that might be impacted by this particular, things that was reported, or for example, by a hypothesis that exchange rates might go in a certain direction. So you kind of state your hypothesis, and then the AI will bring information to you that really connect the dots and really summarizes it in something actionable. I think this is really the power of AI, which is it has an uncanny ability to fill the blanks. For example, if you have incomplete information, it can really effectively fill the blanks and actually give you a sort of a good trajectory. It's like the next level of sort of interpolation. And then the second part is really connecting the dots. You can ask very complex questions that span multiple elements, multiple factors. It could be macro factors, micro factor, your own research, your own data. And this comes into a hypothesis, comes into something that really connects those dots in a way that is almost like is very human, but in a way is superhuman because it processes this incredible amounts of information. And then, the summarization, it can give you, like imagine, for example, a banker wakes up, gets an email that says, from an AI, and says, this just happened in the world. This might impact the following clients. These are the 3 talking points that you should tell them. And it's a very pointed, very...
And how far away are we from that?
I think we're actually not that far away from that. And right now the challenge is really, and for us it's been a big focus, is how to make it safe in the sense that the information is actually correct and accurate, because AI is started as a very plausible answer engine. It gives you things that sounds really, really good, but then sometimes they turn out to be incorrect. And so we've done a lot of work to really make sure that you merge the ability to kind of produce content with the ability to actually retrieve content and then cross-check it and make sure that it's correct. And so that is, a very important part. And I think, the state of the art is moving really, really fast. And so I think we're getting, very close to have something that, is nothing short than a revolution.
Marco, you sound like a tech guy, not a finance guy, because you are a tech guy, right? You came from Amazon Web Services before. And making that transition from native tech to finance, talk to me about the difference between them, and how good does big finance need to be at tech? And how does the firm think about it versus an actual tech firm?
Well, see, when I was at Amazon, I was working on digital transformation on some of the large industrial companies in the world, and especially I work a lot with automotive manufacturers. And that made me realize that software is actually becoming the key component of every industry. Think about the evolution of a car that goes from being a mechanical thing to almost being, like right now, a data center on wheels. And that is really happening in every segment. And so I think the big difference today is the fact that technology is no longer the back office IT organization. Technology is actually the driver of a lot of competitive advantage, and actually is the driver of the strategic agenda of the firm in many cases. And so I think the evolution here has been technologists have a seat at the table when it comes to strategic directions. And one of the cultural changes that we've been trying to apply at Goldman is the idea of, for developers, which is theoretically a little bit unnatural, to go from focusing on the how to actually focusing on the why. We call it working backwards from the customer, really understanding what problems you're trying to solve, really understanding who is your customer, and then from that being able to articulate it together with the business owners, and then turn it into a solution. And that reversal of priority from how first to why first, I think is something that really characterizes the new role of the engineer. Engineers' roles have changed, and today is kind of a mix between data science, traditional development, and business that come together in this powerful combination that I think really drives the strategic agenda of any firm.
I do want to ask you sort of some bigger picture questions about the business. There is a report today in the FT about Goldman potentially exiting an investment in advisory business, which I know is not your purview. But I would ask, as Goldman sort of tries to make some transformations, how you see your role in assisting in that sort of restructuring or pivoting of the business.
Yeah, so of course there is a lot of technology involved in everything that we do. I think one of the observations that maybe I can share with you is the fact that the importance of data is central for us to make decisions, but also for us to course correct any decision. And I think really a really big investment and a little big focus that we had in the past few years is really to create an infrastructure within the firm that allows data to flow freely in a way, and also to be summarized and to be consumed by business owners in a way that actually allows us to make decisions that are faster and potentially more accurate than before. And so as you kind of navigate a world that is changing at a pace that we've probably never seen, where you have what we call like the tail events that are becoming more and more frequent, I think the role of technologists to kind of make sure that people that are the ultimate business decision makers have the right data in order to make those decisions in a very informed way, I think is absolutely central, especially in a time of change.
Speaking of a time of change, I would be remiss if I didn't ask about some of the noise surrounding the firm right now and the leadership of the firm, as someone who is a leader at the firm. What can you tell us sort of about the vibe inside Goldman right now, the feeling inside Goldman, and how you are leading your people right now?
Well, we have no shortage of things to do. We're in the middle of an AI revolution. I think we really keep a steady course. We think our strategy is very solid, and we have an absolute focus on the business right now. So the focus on the business and the focus on our strategy is kind of the noise filter. So we kind of leave the noise outside in a way.
Understood. Marco Argenti,
thank you
so much for being here. Really appreciate it. Goldman Sachs Chief Information Officer.
Take care. Thank you so much.
Appreciate your time. Yeah. Well, we have a solid week ahead of us with housing data, the Fed, big earnings. Here to break it all down for us, Yahoo finance reporter Josh Schaefer. Hey, Josh.
Hey, Julie. Yeah, so we got another fun week to close out, or almost close out August for us here. And right now what I have next to me is the earnings scheduled for this week. So you can see we're expecting Zoom today. We're going to have Dick's Sporting Goods and Lowe's later this week, Urban Outfitters, Macy's, Gap, another look at that consumer. But the big one here, we gave it its own special day. I should mention companies like Peloton also report on Wednesday, but we did circle out Nvidia on purpose. This will be a key market driver to find out what we know more about in that artificial intelligence story. You remember Nvidia boosting its guidance last quarter, saying it expected revenue to grow about 50% more than it initially had. That sent the stock soaring. that sent really the stock market soaring and the Nasdaq soaring in that overall AI hype story. The street right now is expecting Nvidia to report about $11 billion in quarterly revenue, so we'll be closely tracking if they meet that number. Julian Emanuel, strategist over at Evercore, said that he thinks how Nvidia performs on Wednesday after the bell could tell us if stocks continue to head down for August or if we get a bounce back. So it seems like not just a report, Julie, for tech there, but maybe a report that tells us about overall market sentiment depending on how it goes.
Yeah, for sure. Let's also talk eco data for the week, because we got some stuff there to pay attention to.
Yeah, it's good. It's another fun week of eco data, and really the big one here is on Friday. But when you take a look, we have existing home sales and some home data that we're going to be taking a look at this week, and then also be interesting to see if manufacturing PMI ticks back up closer to that 50 number. But you notice there's not a lot of the bigger stuff we normally talk about in terms of any look at inflation or labor, which is important to note because we have Federal Reserve Chair Jay Powell speaking on Friday at Jackson Hole. Now, some economists think that we won't get much of an indicator on what the Fed feels about rates for the September meeting and if they're going to move again, because we don't have those key data points. We're going to have the labor report come next week. We're going to have another print on inflation also come next week. So I think what the large portion of the focus is going to be for this meeting is how Chair Powell feels about the overall resilient economy that we've been talking about for the last 2 months. Has it been too resilient? And does he come out and be more hawkish? There are some people sort of anticipating that. So the final thing I want to take a look at here is just the September expectations for if the Fed were to move or not. You can see here right now the market is pricing in a nearly 89% chance that the Fed does not move interest rates come September. This will be the chart I'm looking at Friday afternoon to see what happens to this chart right here after Chair Powell speaks. Do we see people more confident that the Fed will hold in September, or is he overly hawkish and maybe there's a little bit more movement here that people might expect to move on interest rates to come in September? That's something I'm excited for come Friday.
I mean, those move a lot, so
yes,
we're definitely going to see something happen there.
Yeah.
We'll see what it is.
We'll
Thanks,
see where
Josh.
it settles.
Appreciate it. All right, we're going to take a quick break. When we come back, much more markets action. You're watching Yahoo Finance. Will this most anticipated recession ever actually come?
I think so. I think it's too premature to completely discount the recessionary fears. I think we're still seeing tightening in lending conditions. We're still seeing a lot of that percolating through the economy. I think we will have a recession, but it will be a mild one.
Republicans are getting set for the first primary debate this Wednesday, but one familiar face will not be in attendance: Donald Trump. The former president took to his social media platform Truth Social to announce that, writing, "The public knows who I am and what a successful presidency I had. I will therefore not be doing the debates." The latest poll from CBS and YouGov has Trump's lead growing, now sitting at 62%. With more on what to expect, I'm joined by George C., Annandale Capital founder and chairman, and John Nichols, national affairs correspondent at The Nation. Thanks to you both for being here. Appreciate it. John, I'm going to go to you first. This feels early. I don't know if it is earlier than usual, but it certainly does. And it also feels sort of less relevant than usual because Trump has such a lead. What should we be watching for in this thing?
Well, first off, it's not that early. The Democrats were debating in August of 2019, and Republicans in the past have often debated, in the year well before primaries and caucuses begin. So it's not that off kilter there. But you're exactly right on the other side, and that is as regards Donald Trump. You've got a situation here where the front runner is saying that he will not participate. This is a huge deal because most of the other candidates, in fact, really all of them, are running to position themselves as an alternative to Trump. When they don't have the alternative candidate there, this really looks like a gathering at the kids' table. It's not, it's not the main event. And Trump is really taking advantage of this. He is, on a variety of levels, using his prominence and his big poll lead to marginalize the debates and to marginalize the other candidates. I think this is going to be especially damaging to Ron DeSantis.
George, what do you make of all of this? And at the same time, also, do Republicans risk putting all their eggs in one basket with Donald Trump, especially considering all of the indictments against him?
Good morning, Julie. Well, I think it's going to be fascinating to watch and see if anybody can break out among this group. It is really the eight dwarfs on the stage right now, with Trump sucking up over 50% of the Republican base and all the polling. And it's been interesting. I think it's been wishful thinking on the part of people who want to turn the page and have somebody new and different instead of former President Trump. And his support has actually hardened and it's gotten stronger as we've gone. It hadn't gotten weaker, and it's not 100 miles wide and 1 inch deep like a lot of people hoped it would be. I think one person in particular who's got to have a really compelling debate is DeSantis. He has collapsed 20% in the polls. The more the American people have seen him, the less they've liked him, and he's got to make a big move. But it'd be really interesting to me to see if Tim Scott or Nikki Haley or Ramaswamy or any of these other people can break out effectively and be an alternative to Trump, because so far there is none.
John, I always sort of struggle with this when we get into election season again, although it feels like we're always in election season these days, sort of how much we in the media feed a particular narrative rather than it actually coming. I mean, it's very circular, isn't it? In other words, what I'm saying is the narrative now has sort of hardened around Trump versus Biden. Is that because the media has sort of created that narrative, or is it really coming from the voters?
Look, I'm probably more willing to criticize the media than anybody. In fact, I've written a number of books on media and politics. And so I'd jump into the fray with you there if I believed it. But the fact of the matter is that these other candidates have been on the trail. They've been in Iowa. They've been in New Hampshire. They've been in South Carolina. They are working very hard. They've spent tens of millions of dollars, and they really haven't gotten traction. So I think on the Republican side, what we have to accept is that Donald Trump, like him or not, agree with him or not, has maintained his status as not just the front runner, but really the defining figure in the Republican Party at this point, at least with the base of the party. And the debates would be very, very important if Trump went into that debate, and especially if Chris Christie was there, as expected, who really wants to attack Trump. Maybe then you would start to have that compare and contrast, that real battle, and that might have an impact. But if Trump doesn't enter into the debates, as he says he won't, then I think his ability to kind of control the narrative within the Republican Party, and by extension into what we anticipate will be a Trump-Biden race, that's not a media creation. In many, many ways, that is a fundamental reality of where the Republican Party is at right now.
George, from an investment perspective, is it too early for investors to begin paying attention to it? It feels early to begin actually making investment decisions on it, but what should they be watching?
It's too early. That's a very valid point. I wouldn't worry about it too much. And I also think that the ability to predict how a certain presidential candidate or aspirant or sitting president is going to affect the economy is overrated. You look at election night 2016 when the market went down over 1,000 points initially on the Dow, and then the next day it was up 250, 300 because there's this adverse reaction to Trump because he was more of a wild card. But then people realized he was going to have very business friendly policies, and they reconsidered very, very rapidly. And you look at President Biden sitting in the office right now, and the oil and gas industry was very timid and very afraid of what he would do. But the reality is his policies have been spectacular for oil and gas because he's limited domestic supply significantly and kept the price of the commodity high. So it's very, very difficult to predict these things well.
Yes, that is a very good reminder, George. John, I want to circle back to my question about the Republicans putting all their eggs in one basket. And I ask that because as we've gotten various news of the indictments, Trump has actually used that to raise more money and sort of solidify his standing with his base. But I do wonder about expansion of his appeal at this point. He's such a known quantity that I wonder if there is any more upside in terms of polling for him against President Biden.
That's a terrific question. And if I watch the polling pretty closely and go into a lot of the crosstabs on that. And I think here's the reality. If Donald Trump is the Republican nominee, he will solidify most of the Republican vote. I mean, he's in some of the polls now at like 59, 60%. I mean, he'll get 85, 88% of the Republican vote, barring some unbelievably unexpected development. And that, by the way, goes beyond his legal troubles. But the interesting thing is that in the matchups with Joe Biden, what we see is that they're polling roughly evenly. But among those people who aren't making a choice between the two candidates, that roughly 10, 12% that is somewhat up for grabs, there's a lot of evidence that they won't go to Trump. And so then the question is, would they go to a third-party candidate, or would they not vote, or do they go to Joe Biden? In any measure of that, the likelihood is that Biden has the advantage. Not a big advantage, but he does have the advantage. And this, of course, is the great concern that Republicans have. Donald Trump will not participate in this debate, probably in other debates. All evidence is that he is solidifying his position within the party, getting his strength with the party base, likely to be the nominee, and yet a good deal of evidence that he can't win in November of 2024. So it's a real difficulty for the Republican Party at this point.
And John, just quickly, you mentioned you don't think his legal troubles are going to slow him down in terms of his candidacy. Did I hear that right?
You heard that exactly right. I watch the polls pretty closely, and I'm actually out there talking to Republicans, and I can tell you that this man has been hit with, I believe, 91 indictments. If it was going to have a real damaging effect on his ability to get the nomination, I think we would have seen it by now.
George, what about you? Do you think among the people you're talking to, are his legal troubles an issue?
I'm going to take a slightly contrary position to John and say that if Cornel West is the Green Party nominee, and if Senator Manchin is on the ticket on an independent platform of no labels, that's very, very bad news for Joe Biden, because that they will suck votes away from him. And I think that it's very, very difficult to get away from a sitting president as a nominee of a major political party. The last one was Lyndon Johnson, and he had Vietnam to push him out. And then former President Trump. It's just really hard not to support your former president, whether you like him or not, when he's running for office again. So I think this is going to be a battle zone. And I think the conventional wisdom around all the seers is that Trump cannot beat Biden. I'm not so sure I buy that. I think it's very, very tight, and this country is very, very divided. And most people would love to see something other than President Biden and former President Trump, but I think we're likely to get that, and it'll be a real war.
John, do you think no labels, if that comes to pass, that makes a difference?
Absolutely. I couldn't agree with George more. I mean, bottom line is that I'm talking about where the polls are at now, kind of the basics of what we know at this point. Those variables of third-party candidates become real factors. And again, remember that the presidential race is not decided nationally. It's not a popular vote race. It is a contest within states. In 2020, it was roughly a football stadium's number of voters that decided the presidency in Wisconsin, Michigan, Pennsylvania. In 2016, in 2020, not just a little bit more of that, adding in Arizona and Georgia. I think in 2024, it's going to be, again, that group of battleground states. And the close contests in those states are likely, not in all of them, but in a number of them. And so this is going to be a real battle. What I would say is there's evidence that Biden has some advantages, obviously as sitting president, and also because of a kind of a cap on where Trump can go. That's what concerns Republicans. Of course, Democrats worry about a no-labels candidacy, a third-party candidacy with the Greens. But the bottom line here is, for Republicans, if they could get beyond Trump, their ability to compete would, by many measures, be greater, at least if you look at a lot of the data. But that's just does not appear to be where they're headed. And again, we're talking about this debate that will occur this week. And this should be a breaking point for the Republicans, a point where they really start to look at their whole field. And if Trump was a participant and did poorly in the debate, that might happen. He isn't going to be a participant. And so they're losing one of these opportunities, one of these openings to potentially have an alternative candidate.
Right. Yeah, that seems exactly why he's not doing it.
Exactly
why would you take the risk, I suppose, from his perspective? George C., Annandale Capital founder and chairman, and John Nichols, national affairs correspondent at The Nation. Thank you both. Really interesting perspective. Appreciate your time this morning.
Thank you, Julie.
We got much more coming up. Stay tuned. You're watching Yahoo Finance.
This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
Homeowners and insurance providers are under financial pressure after Tropical Storm Hilary pushed through Southern California and Nevada over the weekend. The storm prompting multiple flash flood warnings issued by the National Weather Service. So could Tropical Storm Hilary send the home insurance industry into a crisis? Joining me now on Hilary's impact is Divya Sangameshwar, Lending Tree's insurance expert, along with our own Danny Romero. Divya, thank you so much for being here. So how should we be thinking about this storm in California and how it's going to affect the insurance industry, given that it's such an unusual storm?
So
I just wanted to clarify, when it comes to hurricanes, the biggest damage comes from flooding, which is not covered by homeowners insurance. So the impact on homeowners insurance on the homeowners insurance industry won't be as much. However, the sad reality in California is just 1.3% of homeowners have flood insurance, which means if their homes are damaged by flooding caused by Hurricane Hilary, they're pretty much on their own. They have to pay out of pocket for the damages.
Divya, it's Danny here, and how many homes are actually considered in the flood zone right now? Do you know, in California?
That's a really good question, because FEMA, according to FEMA, it's probably around 200,000 homes. But FEMA uses old flood data to determine flood risk. So some of the maps that FEMA uses are using data from the 1980s and the 1990s. And California's climate has changed significantly since then. So I looked at First Street Foundation, which does an amazing modeling of flood risk across the country. And according to them, 23% of homes in California face significant risk from flooding.
Of course, it's not just in California where we've seen flooding, right? We've seen it a number of other weather events. We see them much more frequently in places like Florida because of the changing dynamics of our climate, because of the increase in flooding. How should we think about, what percentage of homeowners? I'm sure it's a higher percentage in Florida, but still not everyone has flood coverage. So are we expecting to see, in general, in the years ahead, a much heavier financial burden for homeowners as a result of these disasters?
So the thing with flood insurance is it should be mandated if you have a mortgage and you live in a FEMA flood zone. However, like I said, FEMA's maps are outdated. So those need to be updated so that homeowners are fully protected. And the second aspect is mortgage companies will start cracking down more on homeowners who don't have flood insurance. So that will also be an added risk. In the long run, it is cheaper to have flood insurance than to not have it. So if there is a takeaway here, it is get flood insurance, even if your mortgage lender doesn't require you to get one, or if you don't think you live in a flood zone, doesn't matter. You should still shop around for flood insurance. If you can't get it through FEMA, you can still get it through private flood insurers, but it is safer to have it than not have it, especially right now where your chances of encountering a flood are much higher than they were, say, 30 years ago.
And what are the factors on why there aren't many flood insurance policies in force, for example, in California right now?
I think a huge part of it is, folks in California tend to have focused more on water scarcity than flooding. And they've been more focused on other disasters like wildfires. The last time California had a hurricane, I think, was in 1997. So this hasn't been an issue until, say, the beginning of this year, when there was massive flooding and 90% of the state was under a flood watch. And right now with this hurricane. So for many Californians, this is probably the first time they're encountering flooding at this scale, and they've been caught unprepared.
Divya, how have the dynamics of the insurance industry changed with firms like State Farm saying they're not going to write new home insurance policies in California?
It is definitely making it harder for the average consumer to get homeowners insurance, because if you have fewer companies operating in a market, then your premiums will increase. And with a major natural disaster like flooding, that's probably going to continue. You're going to have premiums go up because of volumes of claims, and it's just going to get more complicated, and you'll see a few more insurance companies pull out because they just cannot cope up with the losses that they're facing and the difficulties they face with raising premiums.
So does that mean then, you talked about that people need to have this flood insurance, right? That seems to even ratchet up the urgency even more. If we're going to have more insurance companies pull out, people should have flood insurance yesterday.
Yeah, you should have flood insurance simply because your homeowner's insurance is not going to cover damages from flooding. And flooding is the most expensive kind of damage that can happen to your house, short of it burning down. So California is facing two of the worst kinds of disasters, and it's putting homes at tremendous risk. So not only should you have a good homeowners insurance policy, you should also be looking into getting flood insurance.
So what is the last resort then for homeowners to do then if they're in this situation?
So right now you cannot get flood insurance. I'm sorry. I wish I had better news for people who are hoping to buy it. It takes 30 days for a policy to kick in. However, given the seriousness of flooding that's happening, I suspect that this area is going to be declared a federal disaster zone, which means two things. One, you can apply for SBA loans to rebuild your home. And two, whatever losses that you ate this year, you can actually use as a tax deduction. So you may not be able to get your insurance to cover the damages, but there is a small silver lining.
Well, that's something. Better than nothing. Divya, thank you so much. Thank you so much in the face of all this to give us some clarity here. Divya Sangameshwar, LendingTree's insurance expert, and our Danny Romero. We got more markets action coming up, and we're going to continue to talk about the effect of climate change on the economy. We'll be right back. Over the weekend, Tropical Storm Hilary slammed into the West Coast. It was a tropical storm at the time and prompted flash flood warnings from the National Weather Service across parts of Southern California and Nevada. As residents braced for the worst from the storm, a magnitude 5.1 earthquake rocked the Los Angeles area Sunday afternoon. Joining me now to discuss the consequences of what such extreme weather means for the global economy is David Calloway, Calloway Climate Insights founder and editor-in-chief. Good to see you, David. We were just talking about the insurance implications, but there are much broader implications. And whether we're talking about the tropical storm hitting California, the wildfires in Hawaii, it feels like we are not prepared for the changes that are being wrought in our climate. How do we change that?
Yeah, I'm not sure we can, Julie. I mean, they're coming fast and furious, right? We scientists have warned for decades that we were going to start to see changes. But I don't even think scientists were prepared for how fast they've come this year and globally, really. I mean, we started with the Canadian wildfires. We had the New York air quality issues. We had flooding in Vermont, wildfires in Greece and Portugal, heat domes in Europe and across the U.S., and then the Maui fires, which were unprecedented. President Biden's on his way to Maui as we speak. And even now, while he's going to Maui to deal with that disaster, which was last week, the new disaster in Southern California is taking place. And these are all unprecedented. What's striking about them is how unpredictable they are, right? I mean, we knew that rising waters were going to cause floods. no one ever thought that a hurricane south of Hawaii would cause a wildfire, or that a hurricane would hit Los Angeles. There hasn't been one in something like 84 years. Or in Phoenix, Arizona, when it was 120 degrees, people will be going to the hospital with third-degree burns on their arms and legs from falling on the pavement. I mean, so each new disaster brings horrible human consequences and staggering economic issues.
David, why is all of this stuff so unpredictable? I mean, we talk all day, it feels like every day on this show about AI, or at least we talked a lot about it, about generative AI. How much more quickly are the models going to get better at predicting these kinds of events, given that we do have better tech that's out there, presumably?
Right. Well, I think, they will get better, right? But remember, generative AI and any sort of AI is only based on what, the AI bot algorithms are taking from the internet, right? It's only the sum of our knowledge. So when we have these unpredictable events, very hard to see that coming. A lot of scientists are talking this week in particular about what happens when we start having dual natural disasters. We saw a little bit yesterday in LA when at the height of the storm, there was also an earthquake, right? But scientists are talking about, what happens when there's, flooding and hurricane and, some sort of horrible heat. I think right now there's something like 5 or 6 hurricanes headed towards the Gulf Coast across the Atlantic Ocean. So we may see something soon, but they're now talking about simultaneous disasters. And to the extent that AI can help us predict and models can help us predict, your previous guest was talking about new types of flood models, which are better than what FEMA has. That's going to be based on what we experience, so that we can plug that into the web, into the sum of our knowledge.
David, one of the other things I wanted to talk to you about was this recent ruling in Montana, in which a number of young people filed suit against the state, saying that the leaders of the state had violated the Constitution by not taking into effect the impacts of climate change when approving oil and gas projects. And they won. That is, these activists did. Do you think we're going to see more cases and more rulings like this, and what effect is that going to have?
Well, I think we're definitely going to, and it's going to issue it's an economic warning to big oil companies, big gas companies, but also big banks and fund managers. This is the first time that a state constitutional clause guaranteeing a healthy environment was applied to climate change. And they chose Montana, the activists, because it had that clause. And they tested it, and they won. There's other states that have that clause, including New York and Pennsylvania. And so the next test could easily come in New York, where a group of youth activists or any activists could sue an oil company in New York or a bank, where a lot of them are based. So I think we will start to see more of these coming. And look, the young people are upset. Now we're seeing more and more of these disasters, just like we talked about a few minutes ago. They're going to start to find ways beyond, throwing paint in museums and handcuffing themselves to parking meters. They're going to start to pursue legal options. And that's not going to solve climate change, but it is going to put those who have funded climate change and those who have perpetuated the dangerous emissions in the atmosphere on notice that there's some legal repercussions these days.
So then just quickly, David, what are the actual repercussions of this ruling? Is it that we're just not going to see oil and gas projects in the state of Montana?
No, I mean, Montana is the most prolific provider of oil and gas projects in the country. I think what you'll start to see is people test the waters a little bit more. The state governments will be a little more reluctant to rubber stamp projects like this. We've seen in Europe they've tested the idea of actually suing for monetary damages, right? So that's the next step for these types of things. I don't think Montana's going to be turning its back on oil and gas projects anytime soon.
Oh, well, all right. David Callaway, thanks so much. Callaway Climate Insights founder and editor-in-chief. Appreciate it. Good to see you.
Thank you, Julie.
Well, a big bank shakeup could be on the horizon. Citi is reportedly considering a structural overhaul that would split its institutional clients group into 3 separate business segments. This is according to reporting from the Financial Times. Yahoo Finance's David Hollerith joins me now with details. So, David, I'm trying to understand why this is important. I mean, obviously, this is important in terms of Jane Fraser's leadership at the bank and the changes she's making. Talk to us, sort of put this in context for us.
Yeah, Julie. So, I think Citigroup is the country's 3rd largest bank, and it has this massive division it calls the Institutional Clients Group, and that houses its investment banking, corporate banking, trading, the private bank, and its larger treasury and cash management division. Per the Financial Times report, what appears to be going on here is that CEO Fraser is sort of splitting this huge part of the business into its own separate segments, which would mean that each of the heads of those divisions would report directly to Fraser. And by consequence, she would have more insight or more oversight into day-to-day business for each of those divisions. Now, Fraser obviously is a part of a long list of Citi CEOs going back to 2000 who have been trying to sort of reshape Citi based on what they think the vision for the bank's success looks like. And historically, Citi has kind of gone into a different direction with each CEO who have led the bank. So Fraser is kind of taking the bank in what appears to be a somewhat of a new direction compared to the past 2 CEOs. Now, it seems like she could be anticipating a strategy of sort of downplaying parts of the bank's sprawling multinational retail business and then putting more emphasis on its capital markets business. And this is sort of the area of banking that Fraser knows the best historically. And, with analysts I've spoken to today, it seems like it could be an optimistic and right way to move the bank for growth in the future. That being said, more focus on global and capital markets will mean that Citi will look a little bit more like Goldman Sachs and Morgan Stanley. And that means that its profits will be a little bit more cyclical.
Interesting. Okay. Well, it looks like investors are still kind of figuring out what to make of this today, especially since it is a longer term plan. The shares are a little changed. And of course, it's not confirmed yet. We should caution as well. Thanks so much, David. Appreciate it. Well, Rochelle Akufa's got you for the next hour of trading. As I look at stocks here, it looks like we now have a bit of a mixed picture. The Dow is now trading off by about 150 points. It's 0.4%. The S&P hovering in the middle here, up just 0.1%. And the Nasdaq is still the strongest of the 3, up about 0.6% here. This is even as we see yields push higher today, which has been a stumbling block for tech, but not for today. Rochelle's got you for the next hour of trading. Have a great day.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. All eyes shift to Jackson Hole this week ahead of the Fed's annual symposium. We'll break down what you should expect from the Fed Chair Powell's speech on Friday. And IPOs up the ante, with Instacart reportedly eyeing a public listing as soon as September. Will other companies jump in line? We'll discuss coming up. Plus, the Writers Guild is calling for regulation in the streaming space. We'll discuss the companies it's calling the new gatekeepers of media. But first, let's take a look at how markets are faring 90 minutes into the trading day. Looking at a mixed picture here with the Dow under some pressure. We see the Dow off about 150 points, or almost about 0.5% there. The S&P 500 in positive territory, but ever so slightly, only up by about 5 points. Tech-heavy Nasdaq, strongest gainer so far this morning, up 82 points, about 0.6%. Obviously coming off a negative week for stocks, but now eyeing, of course, Fed commentary from Jackson Hole. You have existing home sales data, and we'll also get some initial jobless claims this week as well. Let's also check in on the Treasury market. We've been eyeing some of those yields that have been on the rise here. You see the 5-year now up just fractionally on the day, though, about 1.8% there. And look at that 10-year. That's the one that's most closely tied to some of the Fed action that we see. That's also up more than 2% on the day, up at 4.34%. And taking a look at the longest term 30-year yield, that's up 1.94%. Well, the S&P 500 is on course for its biggest monthly loss so far this year as Treasury yields spike. The 10-year and 30-year are on track to surpass highs as wary investors come face to face with sticky inflation and the possibility of more policy tightening. Joining us now is Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Good to have you on the show. So as we take a look, obviously a lot of data for the markets to try and dive into, but I want to first start off by what we're seeing with these yields and some of the signals that we should be paying attention to in the economy.
Yeah, thank you for having me. And it is really interesting how quickly that longer end of the yield curve, so when you're looking at the 10-year going out to the 30-year, that it seemed to become somewhat unhinged, right? You had this big move from below 3.8% up to now around 4.3, 4.35%. And a lot of times what ends up happening as the Fed gets closer to being in this holding pattern for rate hikes, that you actually end up seeing the short end move down as opposed to the long end moving up. So it's a little unique in this type of environment because we have had surprisingly strong growth, and yet budget deficits are incredibly high. So it's really that almost toxic combination of too strong of growth, which seems weird that that'd be part of the toxic mix, but for the bond market, it can be. And then also the massive issuance from the US government that's driving those yields higher. What I would be really watching, and what we're watching here at Annex on our investment committee, are credit spreads. Credit spreads still seem relatively well contained. And so this is almost, from our view, something that is more focused on the Treasury market and not necessarily a negative indicator for the broader equity market. But we do still need to stay tuned.
And of course, keeping an eye on that surprisingly strong U.S. economic growth that we've seen in the third quarter. But you've on the back end of that, you have still the elevated inflation, high interest rates, people's what's left of their pandemic savings running out as well. And then, of course, we're going to have student loan repayments kicking in as well. This strong growth that we're seeing, how sustainable is this? And when do you think a reality check will kick in?
Yeah, from our view, it seems like it isn't really all that sustainable. It's almost like it's an environment in which every sector of the economy is going to have a chance to struggle and then a chance to shine. Last year, it was manufacturing and housing, but now we're beginning to see housing come back a little bit, especially with new home sales and with home builder activity. It's the service sector activity that seems like maybe that's going to start to struggle a little bit as people do exhaust those COVID savings, student loan repayments begin, and then also a lot of the growth that we have seen with consumer spending has been highly correlated with an increase in consumer indebtedness with credit card debt. And that bill does come due eventually. It's not necessarily something that happens abruptly. It is almost something that happens very gradually. We would expect that we could see a fairly challenging fourth quarter. So while the third quarter here is off to a pretty good start, we wouldn't declare victory yet for a soft landing.
And so with that in mind, then, when we look at some of the projections for the S&P 500, obviously this month that we're looking at now, but I mean, we have some people projecting, a massive crash at the end of the year. How do you see the rest of the year playing out for the S&P?
Yeah, the way that we're thinking about it is that in our quarterly outlook that we put out last month, right, so at the end of June, it was about being in the eye of the storm. So you had kind of the worst part of the storm maybe back in October of 2022. We had a very good start to this year with the equity market, caught a lot of people off guard because the broad narrative was that it was the first half that was going to be challenging and the second half was going to look a lot better. Well, now it kind of looks like maybe that script has been flipped a little bit, and it's the second half that is likely to be more challenging. And so we're thinking that we're probably going to have somewhat flat markets from start to finish. It doesn't mean flat in between, right? It's kind of like a roller coaster. It goes up and down, and you come back, you end where you began. And that is what the rest of this year could look like if we're thinking about the third and the fourth quarter. So we're really focused on looking for that intersection of quality and value with our equity exposures.
And speaking of roller coaster, obviously we're going to be hearing from Fed Chair Jay Powell at the end of this week. If there's one thing that you're looking out for, whether it's tone or something you're expecting him to hone in on, what would that be?
Yeah, I just hope it's the complete opposite of last year when he spoke, where he basically said there will be pain. Now, he can't really say that there will be a great gain to the pain that some sectors of the economy have experienced, manufacturing being in a recession, the doldrums in the housing market. But the real pain as far as with the labor market isn't really likely to show up. So he's probably going to focus more on talking about how real yields now are all positive. Monetary policy is likely close to being sufficiently restrictive. So there isn't more pain to come. So I think that's going to be a key thing that I'm going to be really listening for. Last year, it was all about there's more we got to do. Pain is coming. And now it's like, okay, well, maybe you've already ripped off the Band-Aid and now we can let the healing begin.
We'll certainly be listening out for that. Great having you on with your commentary this morning. Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Thank you so much.
Thank you.
Of course, all eyes will be on Jackson Hole, Wyoming this week as central bankers gather in the mountains for their annual meeting. Joining us now with everything we need to know before the big trip is Yahoo finance reporter Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. As Treasury yields are trading near their highest level in 15 years, all eyes will be on Fed Chair Jay Powell's policy speech this Friday in Jackson Hole for just how hawkish the Fed is right now. The Fed minutes last week revealed that the majority of Fed officials were actually in favor of further rate hikes last meeting, noting that inflation still remained unacceptably high and most members saw, quote, significant upside risks to inflation. Since then, of course, a couple more inflation reports have showed more cooling. But with markets on edge, Fed Chair Jay Powell is expected to echo his message from the July policy meeting that inflation remains too high and that the Fed is committed to bringing inflation back down to the central bank's 2% target. Of course, the devil is in the details and the key will be in his nuances. Does he hint that the Fed is encouraged with the latest string of cooler inflation data and at a point where the Fed can move into an extended pause? Or will he set the table for still another one or two more rate hikes? Rochelle?
And we know we'll be passing through every bit of intonation in his voice there. Now, talk to us about nominal rates as well and the impact that they're having on real rates.
Yeah, this is very key, and your last guest brought this up as well. We've seen nominal yields on the 10-year Treasury go up over 4.3% this morning, as you mentioned, coming into the program. That means that real yields, which is adjusting for inflation, are bumping up against 2%. And bond traders have been telling me if real yields were to get above that 2% level, that could be problematic for the Fed. It raises the question of how they would filter that into setting monetary policy if the bond market begins doing the Fed's work for it. Of course, I'm going to be in Jackson Hole later this week. I'm going to put this question to Fed officials themselves to find out. And the other point I just want to make is that even though we are at or near the point where the Fed could move into an extended hold, the next very big pertinent question is how long will the Fed remain at those levels? Right now, perhaps the question is the market under anticipating how long they will see a 5 handle on the Fed funds rate? If it's longer than anticipated, that could create some market reverberations. Rochelle?
We know you'll be keeping track of all of that for us and keeping us up to speed from Jackson Hole. Our very own Jennifer Schonberger. Thanks so much. All right, all your markets action is still ahead. Stay tuned. You're watching Yahoo Finance.
Will this most anticipated recession ever actually come?
I think so. I think it's too premature to completely discount the recessionary fears. I think we're still seeing tightening in lending conditions. We're still seeing a lot of that percolating through the economy. I think we will have a recession, but it will be a mild one.
This year in tech has been largely focused on generative AI. And while there are a number of issues to explore and to problem solve, consumers are generally excited about using new platforms to streamline their activities. Now, because of this, the use of AI in fintech is expected to exceed 6.2 million by 2032. That's according to data from Market US. Our next guest is one of many companies driving innovation in AI, particularly AI in the fintech space. Marqeta is a card issuing platform for businesses, and it's launching a new AI-powered question and answer tool called Marqeta Docs AI. Let's bring in Marqeta CEO Simon Khalaf to discuss this more. Thank you for joining me on the show this morning. So talk about the goal here and how you plan on disrupting this particular aspect of fintech for consumers.
Rochelle, thank you for having me and having Marqeta on your show. Actually, Yahoo Finance has a soft spot in my heart. I was part of your team. And thank you for keeping the brand alive and kicking. So excited about that. So there's plenty of opportunities for AI in financial services. Actually, for us, the bar is quite high because let's say in every part of technology, generative AI has to generate content. Why in financial services, most of the time, generative AI has to generate money. So the bar is high, but we're at it. We're going at it. We're very excited about it. And then I'd say there's like 4 areas in which we are focused on. The first one is personalization, so that you can deliver highly personalized services to consumers. Second one is risk reduction. Third one is better customer service that everybody expects. And last but not least is expanding the credit equity for consumers.
And I want to dig into that because one of the things we're looking at is a predictive credit card. So for the layperson who's trying to understand what that means in terms of equity and access to things like, a good credit score or access to credit, what does that mean?
Yeah, let me simplify it for you. I think consumers got used to personalization. If you look at the Yahoo homepage, it has been personalized for about 7 years. Every person gets their own version of the Yahoo homepage. The search results on Google are personalized. Your social feed is personalized. Your music list is personalized. But if you look at the credit card or the payment card, it's the most adopted piece of technology ever known to humankind. It has more distribution than Google, Yahoo, Facebook combined, and it's still a piece of plastic. So what that means is that the card becomes a technology product. It becomes a virtual product that changes with the behavior of the consumer. So what could change? The first one is underwriting, which is how much credit do you get? But you don't get it as a person. You get it on a transaction by transaction basis. The second thing that would change is the rewards, which is how many rewards do you get when you purchase something? And there's many other things about a credit card that can change. It learns from your behavior as a consumer and it adapts. The same thing every other technology product has gotten. So I think taking all the learning from media companies, from big tech platform, and applying them to financial services, and especially credit card, which is the most adopted technology product, by the way, right, is going to give consumers a lot, especially on the equity side.
Because one of the things that people worry about is bias with some of these AI models. Obviously, a lot of these AI models are only as good as the data that goes into them. How do you manage potential bias that's already pre-existing in the models when the model is trying to figure out, credit worthiness of people coming into the market?
Of course. I mean, there's definitely, exactly as you suggested, Rochelle, models are as biased as the data that's training them. But if you look at the premise of what we are doing, we're actually breaking down the credit decision to a transaction at a time, not to a human at a time. So let me give you an example. Most credit decisions are done based on a credit score, a FICO score, which is given to an individual. And we all know that this score is antiquated. And I'd say that a lot of time it is based on your historical financial behavior. Well, what we do here at Marqeta, we actually break down a consumer to multiple transactions. And we actually have the ability to work with our partners and do it ourselves to underwrite you at one transaction at a time. We look at the credit risk one transaction at a time, and that significantly reduces the risk profile, and at the same time open up the credit box and allow more and more equitable access to credit one transaction at a time. So instead of, let's say, giving you, just as an example, $2,000 of credit limit, we actually focus on one transaction. Let's say you just wanted to buy, just fill up your car with gas and just put $100. The decision is made on that $100 specifically. And does it get paid in installment, or it gets paid, we lend you the money, or our partners lend you the money, and then you've got 60 days to pay. So by breaking down the credit risk to one transaction at a time, we've changed the game here, and we've opened up the credit box for so many.
And certainly that hyper-personalization is something that we have seen in other aspects of tech, but certainly haven't seen that as much when it comes to credit and creditworthiness. I want to talk about some of the partnerships that you have when we're looking at Block and Cash App. How do you pick the partners that you work with, and perhaps who could be some other potential partners who you'd like to sort of grow with to expand the business and grow it?
Yeah, Rochelle, the most interesting thing is partners pick us. We're a platform. I mean, we're aiming to be the operating system of embedded finance, which is a platform play that allows everybody who wants to embed financial services in their own application, in their own workflow, to deliver to all their consumers and audiences the financial services. We're very excited about the innovation we're doing with Square and Cash App. It's phenomenal, the growth that this company has seen. We're excited by it. But we have many partnerships. I can give you examples in the spaces where we have partnership and we're seeking partnerships. I'd say marketplaces, most importantly, tech marketplaces or retail marketplaces. We can provide point of sale lending, exactly how we talked about in terms of providing item by item or transaction by transaction lending. We can provide co-branded credit cards that interact with the marketplace, interact with the consumers, and offer rewards that are integrated with the marketplace. At the same time, we can offer seller financing. So there's many areas in technology and in retail in which we can add a lot of value. So I'd say marketplaces would be something that we're seeking more partners to distribute and to give the consumers of these marketplaces on both sides, buyers and sellers, great financial elasticity.
And certainly, people need as many options as possible. So it's certainly interesting to see the innovations that you're making in this space. Thank you so much for joining us this morning. Marqeta CEO Simon Khalaf, thank you so much.
Thank you for having me, Rochelle.
Well, a lot of speculation has surrounded the chances of a Bitcoin spot ETF being approved, given how much scrutiny the sector is feeling from regulators. Let's bring in Yahoo Finance's David Hollerith to discuss this more. David, we know that we've been hearing a lot about the potential for this, but not seeing any companies quite make it to the finish line just yet.
Hey, Rochelle. Yeah, since BlackRock's filing, which happened earlier this summer, there's been 8 other companies who've refiled applications to list a spot Bitcoin ETF. And that's included ARK Invest, Bitwise, VanEck, Wisdom Tree, and Invesco. And now the SEC has several opportunities from here to either approve, deny, or simply push off approval for these applications. They can't push off approval after 6 months from now. That's when we'll have a definite decision about whether or not the agency would be okay with listing these products. But that being said, earlier this month, ARK Invest's application was pushed off approval. And the deadline for these other applications from the other asset managers are coming at the beginning of September. And John Reed Stark, who is a former attorney for the SEC's enforcement division, sort of weighed in on this at the end of last week. And he had said, he puts the chances at slim to none. Stark, obviously, having worked for the agency, does know a lot about the enforcement division. And his thoughts are that the Bitcoin spot market it's a little bit too not regulated enough and a little bit too manipulatable, which has been the argument in past years for why there's been no approval. But a lot of people have really come out around the BlackRock filing, and Bloomberg's ETF team, Bloomberg Intelligence's ETF team, which is been more bullish on the prospects of approval in the coming 6 months, has said, the question is really, what could BlackRock know that these other filers didn't know at the time? They added a surveillance sharing agreement, which has sort of been taken as like a new addition to this. And potentially, people have said that might be what will make the change for the SEC to approve it. But at this point, it is still pretty unclear about how things could go. We're looking at the Grayscale lawsuit with the SEC, which we're expecting a verdict on, any week now. And that's expected usually on a Tuesday or a Friday is when these verdicts come out. Obviously, Grayscale is trying to convert their GBTC product into an ETF, and that's been a long battle. So we could see some more clarity into the SEC's thinking with that verdict, or at least with what they have to do next, depending on the judge's interpretations. But we're not expecting it to be a clear path for ETFs either, given that the verdict could mean a few different things. But that being said, Bloomberg's team, which again I said has been a little bit more bullish, has said the odds of a Bitcoin spot ETF, they've placed it at around 65% at this point. So that's much better than it was before BlackRock filed for the product.
I mean, you figure if BlackRock can't make it, what chance do some of these smaller companies have? Indeed. But thank you for getting us up to speed. And we will be taking a look at those enforcement actions as well. Our very own David Hollerith, thanks so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
Arm is expected to release info on its much anticipated IPO as soon as today. So what should investors expect? Let's bring in Yahoo Finance's Ines Ferre to dig into this more. Hey, Ines.
Hey, Rochelle. Yeah, and this is going to be a very much anticipated IPO because ARM's IPO will be the biggest this year and the biggest since Rivian's IPO. You'll remember that in November of 2021. So just to back up a minute, ARM is a British-based chip designer. It sells blueprints that are needed for designing chips, and the chip designs are used in most of smartphones. Nvidia tried to buy ARM at $40 billion, but because of customer and regulatory pushback, that deal did not go through. Now, SoftBank recently bought a 25% stake in ARM that it didn't own directly previously, that was held by its Vision Fund unit. And SoftBank essentially, by doing that, was buying out the Vision Fund's Middle Eastern backers. Now, by some calculations, you see it right there. The chip designer is valued at more than $64 billion, anywhere between 60 and 70. And according to the Wall Street Journal, some people familiar with the matter say that SoftBank is aiming to sell about 10% of the company in the offering. And also, this offering will give SoftBank the ability to sell its holding in ARM over time to reap future benefits, gains, if the stock price appreciates. Now, the initial filing likely that will be dropped today, it is expected to be dropped today, likely won't include the IPO price or a target price there. That comes later. The target range comes later. Also, the roadshow will be happening as well, and that will be where executives are meeting with potential investors. But what we should be expecting today are details about the company, about its financials, its recent financials. This is also the opportunity for the company to lay out the risks for investors if they do decide to invest in this company. So it'll be really interesting because, again, it's a big IPO. And also, remember, this is related to AI and the big AI frenzy that we have seen. So there will be a lot of interest about this, not just this IPO, but also the investor appetite when it comes to AI.
Yeah, we'll certainly have to see how that plays out in the IPO market. Appreciate that update. Our very own Ines Ferre there. Well, according to data compiled by Bloomberg, $14 billion has been raised in IPOs on U.S. exchanges. Now, that's down from the record-setting $241 billion amount raised in 2021. But IPO activity has been on the rise this year, as the market has been introduced to some popular companies across several industries, such as Carver, Savers Value Village, and Kodiak Gas Services. Now, investors are keeping now an eye on several IPOs, from SoftBank's ARM to SpaceX and Instacart. Let's bring in Rainmaker Security's Managing Director Greg Martin to talk more about how investors can think about Instacart's upcoming IPO and what it might mean for the health of the IPO market. Good to have you on the show here. So let's first start with Instacart here. Really, the timing of coming into this. We know that there were several delays. And there were concerns that the CEO said about, an extremely volatile market, so it wasn't a good time to do it last year. Doesn't seem like the markets are super stable this year either. So talk about the timing of this.
Well, thank you for having me, Rochelle. Instacart's an interesting story. It was a company that founded, in 2012, soared during COVID, of course, as people couldn't go to grocery stores. And so online grocery really took off, and they've been talking about going public for about 3 years now, as you referenced. They hired bankers in 2020. They filed in 2022. And the question is, as you point out, is now a good time to go public? I think, with the success of some recent IPOs, and you mentioned a couple, and we can add Oddity and VinFast to that list, the market has shown some receptivity to new issuances. And so I think that's positive. We've seen some, clearly rates have stabilized a lot. So it's a lot better than it was a year ago. And I think there's a more positive, economic outlook than there was previously. And so I do think that there's demand for growth companies. And Instacart has a little bit of a tricky story because on the one hand, it's growing due to its growth in its ad sales, but its growth in its actual transaction volume, meaning the value of groceries that are being delivered, actually isn't growing very much. And so it's going to be an interesting case study to see just how receptive the market is to new issuances.
And you raise an interesting point that it really is the ad space that was driving the revenue that they saw. They saw revenue grow more than 30%, about $1.4 billion in the first half of this year, according to some reports from The Information. But then when it comes to those delivery services, barely budged. So how would they be positioned, say, against an Uber in this sort of space?
Yeah, I mean, the company will clearly be comped against DoorDash and Uber, as you point out, whose growth, and if you think about how they think about growth, they think about, for Uber, the total, value of cab fare, or for DoorDash, the total, value of products delivered. The challenge because they're all, somehow related on a percentage basis, the challenge with Instacart is its actual grocery volume, and think of Instacart as sort of taking a percentage of grocery volume that you purchase, is actually not growing very fast, somewhere between 3 and 5%, even though growth is listed at 30% growth, primarily because they're actually growing the ad revenue. So when people go to the app, brands advertise so that people will purchase, their goods in the store. And I do think that will go to how much growth potential they have in the future. And I think the market will have a challenge as to, do we value the business more on the ad revenue growth, which is actually very high margin and a very good business, but may have some caps, because ultimately the ad business has to be related to how much product can be sold. And so I think it's going to be interesting to see which one takes over, because it is going to be a challenge, because they aren't growing as fast on the GMV side as Uber and DoorDash.
And as we look at some of the more successful IPOs this year, say a Kava, for example, where, this is a more premium food brand, people are willing to pay a little bit more for Kava. But then when you think of Instacart and sort of the fees that they tack on there, in terms of what consumers would be willing to pay and their willingness to stick with Instacart, do you get the same feeling that they'll be as successful as, say, a Kava has been?
It's an interesting question, because I'm probably one of Instacart's biggest customers. I think there's an Instacart delivery to my house every day. So I have to speak less as a customer and think more broadly, because I do think that there is a premium that is paid for the convenience of having Instacart delivered to your home. And now that people are out, going back to work, feeling comfortable going to grocery stores, I do think that cost, can be prohibitive, especially as we get, we see inflation, people are more, have less discretionary income. And so I do think that's a factor. And it already has hit them. Obviously, they're not growing the same level they were during COVID. And so, but then people start to make the equation of, how valuable is their time? There's a reason why DoorDash is still, growing pretty well, because people value the convenience versus, the cost and the time cost of going to a store. But I do think that Instacart has been more impacted because the premium cost of delivery is starting to impact people.
And I want to talk more broadly about, just quickly, the IPO space itself. If we're keeping an eye on the ARM IPO and then Instacart coming, do we get the sense that there is more of an appetite now, or are there specific sectors that are really going to benefit the most and get the most investor interest?
If you think about an IPO and you think about investor dollars, they're comparing it to what their alternative is, right? The risk-free rate is roughly, 5 to 6%, depending on what you're purchasing. If you think about T-bills or muni bonds, as rates have gone up. And so that creates a much higher bar for companies to go public. I do think that investors are still looking for higher yield, and so they are looking for growth businesses. But I think they're looking for growth businesses that can also show strong unit economics, strong profitability. And so I think the companies that will succeed are able to show growth, but also able to show that they have a really good, profitable business model. And so I think we're seeing those types of companies, Oddity and Kava, they have, excellent growth potential, and solid unit economics. And so I think versus maybe 2021, where anything that was growing, almost regardless of whether it had a good business model, was well received, I think we're going to see a much more scrutinizing public. And, I expect we will see a titration, meaning a sort of filtering in of companies, so that underwriters can give IPO buyers who take that risk a little pop. And eventually the floodgates may open if we see more stability and more, successful IPO performance.
We'll certainly be keeping an eye on that. Appreciate you joining me this morning. Rainmaker Securities Managing Director Greg Martin, thank you so much.
Thank you.
Well, as a country develops, it needs several things to be self-sustaining, the least of which is a continued population. Now, it's been long thought that a replacement rate of 2.1, that's the number of children a couple should have in order to replace themselves, is enough to sustain a country's development. Well, as we take a look at the data, the ominous second demographic transition, or baby bust, has also been talked about. Despite the United Nations saying this year that the global population will continue to expand, the world's 15 largest economies all have fertility rates below that of the replacement rate. Now, often mentioned as a reason for the declining population is the cost of living being so high. Data from the Bureau of Labor Statistics shows that even though overall inflation has fallen, the cost for childcare remains elevated. And a recent study from the Brookings Institute shows that average middle-income family with 2 children will spend over $300,000 to raise a child that was born in 2015 until they are 17 years old. Now, that's up more than 9% based on a calculation from the inflation rate 2 years ago. All right, stay with us. All your markets action still ahead. You're watching Yahoo Finance.
What story is not being talked about enough this year?
I think the story that's not being talked enough is this concept of the recession that everyone's expecting may actually feel and look a lot different. And so we're of the belief that we're actually seeing rolling recessions. And so what's important to investors is really about, are we in a profits or earnings recession? Yes, we do believe that there's going to be an economic recession, but when we look at profits recessions, last year, we saw a profits recession in 7 out of the 11 sectors in Q4 of last year. You could argue technology was in a profits recession last year as well. And so instead of this feeling like everything all at once, it really is going to be this rolling where parts of the economy, like manufacturing, are seeing declines, but other parts seem resilient.
Healthcare stocks are under pressure this morning after plummeting last week on news of a major industry shakeup by Blue Shield of California. The health plan company, which services almost 5 million Californians, announced it will be making changes to its pharmacy benefit managers. PBMS negotiated drug spending for insurers and play a major role in determining access to and the cost of drugs. California Blue Shield will give portions to industry disruptors like Amazon Pharmacy and Mark Cuban's Cost Plus drugs. The move is expected to save Blue Shield of California $500 million annually, CEO Paul Markovich told Yahoo Finance. Now, Anjali Kamlani spoke with the executive and has more on this story. Hey, Anjali.
Hey, Rochelle, that's right. So, of course, what we saw last week was what some called a shakeup in PBM land with the California Blue Shield deciding that it would split the responsibility of a PBM between 5 vendors. That includes Amazon Pharmacy as well as Mark Cuban's Cost Plus. That is a reduction for CVS, which took the biggest hit. But CVS is still kept on board for the drug specialty process. Now, when I spoke to Paul, he told me that this was actually a pre-COVID plan. It's been 2 years in the making. They did an elongated RFP process, and he's pretty confident they're going to reach that $500 million in savings. But some experts pointed out to me that there could be a negotiation process if, for example, CVS is upset with what it is being delegated. But they do seem to say that that's unlikely. And the goal really here is just to take cost out of the system. This comes after frustrations over some drugs that the prices were not lowered for, according to the report. So when I spoke to Paul, he told me, quote, "We're creating a different mousetrap here. We've done the math." And that is on the heels of criticism that they may not actually reach that $500 million, that if there were, in fact, $500 million in savings, other players would likely have done that before. To that point, there have been other attempts at unbundling, which is what this is called. And what's interesting to note is that Paul's not married to the idea of these disruptors. I think that's what caused most of the shock last week with Amazon and Cost Plus drugs being chosen to do that. You know, they both launched during the pandemic and have really grown as a result. So those players could change over time. It could not be Amazon Pharmacy in the future, but anyone else that comes across. Abarca is one of those that really not a well-known player, but handling the PBM for Medicaid in Puerto Rico. It's a Puerto Rico-based company. And so it's really interesting to see how that mix of players came to be in this first round. So while unbundling does seem to be the long-term strategy, according to Paul, the players who are in that queue could change. So that'll be interesting to watch as this unfolds in the next couple of years.
We'll certainly watch this space. For now, investors not sure what to make of it, but fascinating to watch. Anjali Kamlani, appreciate that update. Well, tomorrow, Paul Markovich, CEO of Blue Shield of California, will speak with Julie and Brad in our 10 a.m. hour. You won't want to miss it. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Will the S&P 500 be higher or lower at the end of earnings season?
Oof, I wish I knew the answer to that definitively. I guess I would say right now the momentum is obviously moving in the higher direction. Earnings expectations, negative 7% growth year over year, so the bar is still pretty low, easy to get over it. I guess if I have to choose one, I'd say higher.
There's a new call for regulation in the streaming space. The Writers Guild of America has issued a new report calling Netflix, Amazon and Disney the, quote, new gatekeepers of the media business, and warns regulators to put a stop to consolidation in the industry. Yahoo Finance's Alexandra Canal has those details. Alexandra, what are you watching?
Hi, Rochelle. Yes, a very fiery report from the Writers Guild of America late last week calling for the end of media consolidation. According to this report, as you just mentioned, Netflix, Amazon, Disney, some of the biggest behemoths in Hollywood right now, they have so much market power, the WGA says, that they are dragging down wages. They're limiting viewer choice. But what really stuck out to me here was that warning about media consolidation. The WGA writing, quote, any mergers in media and entertainment involving significant streaming players should be blocked, including acquisitions of smaller or potential competitors. And this is something that has been potentially on the horizon for quite some time. Consolidation, which many executives have argued, is the name of the game. There are too many streaming services out there. I think you can see that by how we've seen a subscriber slow down over the past year or so, those numbers slowing significantly. On top of that, companies have been struggling with profitability as streaming losses continue to be a problem. That's why we've seen more ad-supported tiers. We've seen a wider crackdown on password sharing. So the expectation over the next 5 years is that we're going to see a lot less media players than we have today, which means the bigger guys who can afford it, which are your Apples, your Amazons of the world, maybe potentially even Netflix, they could gobble up some of those smaller players. And if that happens, the writers are going to feel the fallout there. And that's what's really making these negotiations so complicated. The writers are not just negotiating for where the media environment is today, they're also trying to negotiate for where the media industry is heading. And there's a lot of question marks around that, especially surrounding AI, streaming residuals, and those are two issues that remain a critical component of these ongoing talks.
I mean, certainly when you consider where traditional media was and where it is now with streamers, it makes sense. So then where do the talks stand today, and is there any end in sight?
Well, the good news is that they're still talking. The progression of those talks is still TBD. There aren't any formal deals being made at this point, but it does seem encouraging that both sides do want to make a deal at this point. Like I said, there's still some sticking points there. The writers, they've been very adamant in their language. They're certainly going to hold off for a good deal. However, we are well past the 100-day mark. We're already seeing the ripple effect throughout the LA economy. Some of our favorite TV shows, movies, they're being weighed to be pushed into 2024 or beyond. So we're entering this critical juncture when it comes to these talks. Hopefully we can strike a deal soon. And I do think if the studios are able to negotiate a deal with the writers, the actors will soon follow. So it all comes down to these negotiations, but we're entering another week of talks, which is a positive.
It's true. As long as the dialogue is still going on, at least that's something. Great stuff there. Our very own Ali Canal. Thanks so much. We're shifting gears here to Tesla. Shares up over 4% this morning, snapping its 6-day losing streak. Baird analyst Ben Kallo cited several catalysts for Tesla's growth trajectory in the latter half of 2023. Now, while Kallo says Tesla's price cuts will continue to impact profit margins, the analyst says in his most recent note that the stock is well positioned for the remainder of the year. That's thanks to the EV maker's Cybertruck launch, growing energy business and expansions into new markets. Now, Kallo also expects Tesla will hit its production guidance of 1.8 million vehicles for the full year. Shares of Rivian, though, ticking slightly higher on that news as well, so a little bit of a benefit there. All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at a mixed picture here. We now see the S&P also joining the Dow that was earlier negative as well. That sell-off continuing. The Dow now off more than 240 points. The S&P 500 there down by a lot less, but obviously still in negative territory. But as we see the tech-heavy Nasdaq there, at least the pushing up is one of the few bright spots in sector-wise on the S&P 500. That's up about 0.4% or about 52 points. Obviously, a lot of information for the markets to digest this morning. Still waiting for what they'll hear out of Jackson Hole from the Federal Reserve. Initial jobless claims also coming out this week. And then, of course, we'll also get a closer look at what's happening with the housing market as well. So lots for investors to digest this week. And Yahoo Finance will, of course, have you covered. That's it for now. I'm Rochelle Kufa. I'm back with you 11 a.m. Eastern tomorrow.